Okay. Morning, ladies and gentlemen. How are we? Guys online, please confirm that you can hear me.
Yes.
It is a cold morning. I thought this class was starting at 9 until they informed me that they started it at 8. My usual classes start at 9. So I am sure most of your colleagues are also still waiting. So we are going to take about 10 minutes to remind our friends to log in, and then we can start. So please inform your friends that we are starting in the next 10 minutes, and then we'll ensure that we are leaving no one behind. The good thing is that we are starting a few minutes before the expected time, and therefore we'll utilize all the available time. Today I'm with you. If you have not carried lunch, if you have not prepared lunch, you might not eat today, but we'll give you breaks along the way to ensure that you can actually get something to eat. If you have not been prepared to pass, it is your right time to prepare to pass. If you go through this session and you don't pass, you just know that you're so unlucky. But there is no one who has gone through this kind of preparation and they don't pass. So prepare to pass. So we'll start at exactly 40 minutes past, but make sure you get into your friends' inboxes and inform them that we are starting shortly. Okay, so I think it is exactly 40 minutes past 8, and we can't wait any longer. So we are going to start this session. I am requesting that all of us mute our microphones, and then we can be able to have a cool environment. I am going to introduce myself for those who are new to the college, so that you're able to know who is speaking to you this morning, and of course, this whole afternoon and evening. My name is Council Julius Nandeva, and I am a tutor at Capital College, teaching paper 11 and paper 17, that is taxation and advanced taxation. And I am also director at Capital College. Outside Capital College, I work with Uganda Revenue Authority as the manager in the large taxpayers office, responsible for the financial and insurance sector. And I am an accountant. I am a professional accountant with CP and ACCA, but I'm also a lawyer. So that gives you a fair background of the person speaking to you. That is not very important for your August sitting. What is important definitely is what I'm going to say. And what I'm going to say is also not my words, but they are engraved within the law. So whatever I say, if you want to actually go back and look at the law, please feel free to look at the law so that you appreciate that whatever you have is within the law. Ladies and gentlemen, without much ado, I am going to tell you the areas that we are going to cover today, and the areas that I must also emphasize you must know. These are must know areas. Number one, we are going to look at the computation of income tax liability. The computation of income tax liability of persons who are engaged in business, or persons who are engaged in business. So you are likely to have your number one as the computation of income tax liability of a person who is engaged in business. And this person is likely to be either of the three. One, either a company or an individual or a partnership. So prepare your number one is going to be on computation of income tax liability, what we call tax payable by a person who is engaged in business. Now, it doesn't matter which kind of business they are engaged in. There are so many businesses and there are so many sectors. It could be agriculture, it could be the financial sector, it could be professional, it could be wholesale, it could be anything. But all you need to know is that this person is going to be engaged in business. And they are going to be asking you to compute the chargeable income and tax payable for someone who is engaged in business. And this person is either going to be a company, a partnership, or an individual. So as you prepare, ask yourself, do I know how to compute the tax payable for a company? Do I know how to prepare a tax computation for an individual? Do I know how to prepare a tax computation for a partnership? That is your number one. Number two area that we are going to look at, not because it is going to be number two in your exam, but the ones that I've said, you can guarantee they are going to be your number one. You're going to have your number one as computation of income tax liability, either from a company, an individual, or partnership. So that is guaranteed. Number two and the rest, I am not sure, but they are going to come from these areas that I'm talking about. So number two area that we are going to look at is what we call employment income. Employment income here, the examiner wants you to calculate pay as you earn. But the question is going to be chargeable income and tax payable. But if you're dealing with someone who is employed in employment, that tax payable is what we call pay as pay as you earn. So as long as you see a question on someone who is in employment, then you know they are looking for pay as you earn. And you're going to be asked again chargeable income and tax payable for that person who is in employment. Number 3 that is a must know is VAT, value added tax. There is a very likelihood that you're going to have a number on VAT. In fact, the likelihood is over 98% chance that you're going to have a number on VAT. So value added tax, we'll go through that. Number 3, you're going to actually have, is that number 3 or number 4? Number 4, you're going to have a number on customs because URA collects both domestic taxes and also customs. So a balanced exam would not come without a number on customs. So you have a number on customs as well as you would have the number on the other VAT areas. So we'll cover some of those, and of course, without forgetting the other residue areas, for example, rental tax, etc., etc. Now, the biggest exam and all other numbers are going to come from those 4 areas that I've talked about. Income tax, computation, the computation on employment income, the computation on VAT, and the computation on customs. And then the other areas are what we call residue areas, for example, to do with rental tax, to do with capital gains, to do with withholding tax. Those are areas that they add within the main areas. Okay, that said, we are going to start with the main area, and that is the one that gives you the highest marks. At advanced taxation, it gives you 50 marks. At taxation, it gives you 40 marks. And my plea to students is that is the area you must master with your heart and soul. Because the moment you master number 1, there is a very likelihood that you're going to actually pass that number 1 highly. And the moment you get at least, if it is out of 40, at least get 30 out of 40. If it is out of 50, at least get 40 out of 50. When you do that, automatically you're done with the exam. You cannot fail to get the remaining marks from the other numbers, because at paper 17, you will have other extra 2 numbers, each one giving you 25 marks. At paper 11, you're going to have other extra 3 numbers, each one giving you 20 marks. So that means if you maximize number 1, it is easier for you to pass that exam. So every question that you have on number 1, please make sure you ask. And whatever I am going to say, whereas you don't have time to understand it now, at least cram it, so that when the exam comes, you actually do it, and then you can understand it after the exam. For now, we are looking at the exam, so whatever I'm going to say, please pick it. Now, I am going to project. Let me project one paper. I can project, let me project an exam like this. This is the December 2024 exam, and I'm going to use this to illustrate certain things that you must be aware of when you actually see a taxation exam or an advanced taxation exam. The advantage is that all the areas I've talked about, number 1, on computation of income tax from business, number 2, on employment income, VAT, and customs, all these cuts across. By the way, paper 11 and paper 17 use the same notes, only that paper 17 has also some advanced areas, and sometimes they also give you some advanced adjustments within paper 17, but they are almost the same, and we use the same notes and the same materials with, of course, a few changes. Now, your number 1 is going to look like this. Your number 1, I want to project this. Let me project this. Just a second, I'm trying to project for you so that you're able to see it.
Good night. Maybe that's what you should know. Agent. Taxation.
Let's mute our microphones, please. Okay, so confirm that you can see my screen.
Yes, sir.
I can see, sir.
Okay, great. Now, I am going to use this question, and I want you to pay attention of the things that you must look for in your number one. The things that the examiner is actually testing in your number one. Principle number one is that they are going to give you a statement of profit or loss in your number one. Whether it is for a company, whether it is an individual, whether it is a partnership, they are going to give you a statement of profit or loss. What is in the statement of profit or loss? Only two things: incomes and expenses. Incomes and expenses. Additionally, from the statement of profit or loss, they are going to give you additional notes. Additional notes or explanatory notes are meant to break down your summarized statement of profit or loss, but they are still talking about incomes and expenses. Number three thing that you're going to see is that they are going to talk about assets within that number one. So you're going to have three things in your question. Number one is going to be a statement of profit or loss that has incomes and also has expenses. But when you go to notes, they'll break down those incomes and expenses, but they will also add notes relating to assets. So why do they give you those three things? Incomes, expenses, and assets. These are the things that you're looking out for. When they give you the statement of profit or loss, you're looking out for only two things. You will look at the incomes, and you're only looking for incomes that should not be included in gross income. So meaning, before you get into the exam, you must know what are those incomes that when I see them, I must go and deduct them in the tax computation, because they have included them in the POL, but they are not meant to be incomes to be taxed. So before you enter the exam, have a list of the incomes that should not be included in the gross income, so that when you see them in the POL, you go directly to the tax computation and knock them off. When it comes expenses, they have given you all the expenses, but they are expenses that are not supposed to be allowable deductions. In other words, whereas the accountant is allowed to include them in the POL, the taxman is saying these expenses are not supposed to be included in the POL, and therefore they want you to identify them and take them to the tax computation and add them back. I will repeat that. This statement of profit or loss is composed of incomes and also expenses. This is prepared by the accountant. You as a tax person, you're looking for, if you look at the incomes, you're telling the accountant, whereas you consider these incomes as part of your gross income, the tax law says some of these incomes should not be part of the gross income. So I want to pick them and take them to the tax computation and remove them, because they are not meant to be part of your income for tax purposes. So the strength of a student and where you're going to get marks is identifying those incomes from the POL and take them to the tax computation. And when you take them to the tax computation, you subtract them, because you're saying they should not be part of gross income. So in this discussion, we are going to be identifying a list of incomes which you're likely to find in the statement of profit or loss. And the moment you see them, please go to the tax computation and remove them. We are also going to look at expenses. These are expenses the accountant is considering to have been incurred by the business. But the tax law has said that some of these expenses should not be allowed for tax purposes. So you want to pick them out so that when you go to the tax computation, you add them back, because you're saying they shouldn't have been subtracted. That is number two on incomes and expenses. What are we looking for in the incomes? Only incomes that should not have been in the gross income. What are we looking for? Expenses. In expenses, we are only looking for the non-allowable deductions. Anything else is not your business. When it comes to the notes of assets, the notes of assets are only looking for capital allowances, meaning in the tax computation, you're taking there about three things. Number one, you're taking their incomes that should not have been included in gross income, and you're subtracting them. You're taking their expenses that are not considered to be allowable deductions. In other words, expenses that we consider to be non-allowable deductions, and you're adding them back. You're also looking at the notes of assets. For example, in this note, you see note number 5 and note number 5 and note number 6 talking about assets. And the moment you see assets, you know they are looking for capital allowances. When you calculate these capital allowances, you also take them to the tax computation and remove them. Now, all you need to know is that you then understand how does my tax computation run. What are the things that I'm going to add back and what are the things I'm going to subtract? So that when I see them, I actually take them to the tax computation. If you've not mastered the tax computation, today you must master how the tax computation runs. So we are going to actually now look at the tax computation and run through it, and then we'll be relating it to what you see here. So allow me project the tax computation. And I want you to pick the most critical items. Can you be able to see my Excel sheet?
Yes, sir.
Are you able to see my Excel sheet?
Yes, sir. We are seeing.
Okay.
Yeah.
Now, my Excel sheet, if you see the numbering, I have number 1, I have number 2, I have number 3. So these numbers, number 1, number 2, and number 3, as your critical headings in that tax computation. And you must know what falls under each heading. Now, first of all, as you get that number, when you open your number 1, and if the question is saying, for example, here our question is saying, if I can open this, our question is saying, advise the management of USL on the chargeable income and corporation tax payable to the Revenue Authority, if any, for the year ended 30th June 2024. In this heading, you're going to be picking about 3 things that you need to know. Number 1, you must know the person that you're dealing with. In this case, it is USL. And they have told you that you're looking for corporation tax payable. Corporation tax means the tax paid by a company. It means you're dealing with a company. Number 2, you're looking for chargeable income. So you must know in your answer that your number 1 requirement is to look for chargeable income. Number 2 is that you're looking for tax payable, because you cannot get tax payable unless you have chargeable income. But they're also telling you that the tax you're looking for is for the period ended 30th June 2024, and you must know when that year began because of the cutoff points. You're likely to actually see transactions getting out of that period if the transaction is this year is starting from 1st July 2023 to 30th June 2024. Your exam is likely to be June 2025, for example, or December 2024. So if it is December 2024, it means your year is running from January to December. Anything that gets out of that year cannot be part of your computation. In other words, it must have an adjustment in your computation, whether it is an expense, whether it is an income. For example, an income that stretches beyond December 2024, if your exam is for December 2024, it means that income, if you received it, but it relates to a period after December 2024, it will be income received in advance, and that would be deferred income which you cannot tax. If it is an expense that you have incurred beyond December 2024, yet the exam is saying December 2024, it means you made a prepayment. When you make a prepayment is not an allowable deduction because it does not relate to that year of income. So the year of income is very important for you to know the transactions that are going to fit in that year of income. Now you realize that the starting point is that you must be able to lay the heading. The heading comes from the question. For example, if this is a question on URS, I would say URS's computation of chargeable income and tax payable for the year ended 30th June 2024. I have laid my heading. Please never do a question without a heading. That is number one. Number two, I set the structure of my answer. When I'm setting the structure of my answer, for the computation of income tax, I specifically need only 3 columns. I specifically need only 3 columns. What are those columns? I need the column of description of particulars where I'm going to be listing my items. I need a column where I'm going to be making my adjustments, if any, and then the column where I'm going to be putting my final answers. So you must know which column do you put figures and which column do you put your final figures. So column number 1 is the description, column number 2 is the first set of figures, and column number 3 is the final set of figures. You're not going to be explaining to the examiner, you're not going to have law applicable, you're not going to be having comments, because the examiner is not interested in the exam to know the law that you have applied. He already knows the law that you have applied. Now, what do you start with when you're looking at that computation? Your mark number one is going to come from the profit or loss before tax. So I want the assurance that everyone can be able to get this number 1, the profit or loss before tax. If you have not mastered this, if you go to the POL, you will always see that profit before tax. Now, if you get into the exam, don't be confused by the different profits. If you get into the exam, don't be confused by the different profits. For example, if you look at the profits here, the first profit is gross profit. You don't need that. The second profit is operating profit. You don't need that. The third profit is profit before tax. That is the profit that you're looking for. And that profit could also be a loss. So if it is a profit, take it as positive. If it is a loss, take it as negative. But you're looking for a profit before tax. Now, in exams where they have not clearly showed you that this is profit before tax, sometimes they call it net profit, sometimes they call it any other name. But all you're looking out for is that the last profit before you remove any income tax expense. So that profit, if you see any profit which has not suffered any income tax expense, is the profit we call profit or loss before tax. So whatever name they call it, please make sure you can be able to pick that profit or loss before tax. Once that is done, you're done with your number 1 item on your tax computation. The next item you're looking for is number 2. And number 2 is that you're looking for the expenses which are in the POL, but the tax law has said these are non-allowable deductions. In simple terms, we are looking for expenses from this POL. We are going to run through the POL and ask, are there any expenses that the accountant has included in the POL, but the taxman is saying they are meant to be non-allowable deductions? And I will tell you how you can identify some of these non-allowable deductions. Now, that is your line number 2. In the exam, please just write the heading, add back non-allowable deductions, and leave half a page because you don't know how many they are going to be. Remember, you're going to the POL, picking them and bringing them under that heading, but the heading is add back non-allowable deductions. That means that you're picking items from the POL, and those items should have been subtracted from the POL for you to say, I am adding them back. You can't add back something that had never been subtracted. You can't add back an income because an income in the POL is added, whereas expenses are subtracted. So by the time you say, I am adding back, you're satisfied that this expense is coming from the POL. I have seen it in the POL, but I am convinced that it is not an allowable deduction for tax purposes, and I am coming to add it back to the profit or loss that I have because I am only making an adjustment to that profit or loss. So we agree that when you say add back non-allowables, you're picking things from where? From the POL. And these things you're picking should only be what? Expenses that the accountant removed in the POL, and you're trying to add them back. That is heading number 2. Heading number 3 is about less allowables. Now, in this heading number 3, I want you to be extremely careful because it is a mixture of incomes and also expenses or expenditures. This less allowables is a mixture of incomes and also a mixture of expenses. So how do you identify the items that you're going to put under less allowables? You will only put incomes under this line. You will put only incomes under this heading, less allowables, if these incomes are coming from the POL. I repeat this. The moment you say less allowables, and an item that you're putting under less allowables is an item of income, it must be coming from the POL. Why? Because you're saying, when I look at your POL, when I see the incomes in the POL, they are incomes that you included in the POL, but are not supposed to be part of the gross income. So I want to remove them. So you cannot remove an income here if it was never included in the POL. So the moment you bring any income in here, it must be income that you're putting from the POL, and the reasoning is I am removing it because it should not be part of the gross income. Whereas you included it in the POL, the tax law says it should not be included in the gross income, so I am removing it. That is category number 1 of incomes. The other thing that you're going to find under less allowables are expenses, what we call allowances. Now, for an expense that gets into these allowables, it should not be coming from the POL. I repeat, please never pick an expense from the POL and bring it here in the allowables. Where do they come from? They are those deductions called allowances that the accountant has not yet considered, but the tax law has said these are also part of the deductions. They are deductions, but in the POL, the accountant has not yet considered them. In other words, the warning is, please don't pick an expense from the POL and bring it here under less allowables, because in the POL, all the expenses that are there have already been allowed. The accountant has already allowed them by subtracting them. If you bring it again under less allowables, you're allowing it the second time. Therefore, under less allowables, if you're bringing any expense or any deduction, it must be a deduction that was never considered by the accountant. And these are some of the deductions you're going to calculate yourself. Some of the capital allowances are going to be under less allowables. If it is an item of income, it must be coming from where? From the POL. that the accountant included in the POL, but you're saying it should not have been included in the POL. That is heading number 3. So the moment you put that heading number 3, also leave another half a page. Remember, you started with profit or loss before tax. The next heading was add back non-allowables. The third heading is less allowables, and you're leaving space. The reason why you're leaving space is that you're setting the format, so that by the time you start now reading the details, you come and be putting in transactions as quickly as you can. The next, once you have those 3 things, the profit or loss before tax, you add back the total of non-allowables, you subtract the total of allowables. What you have is the first answer they are looking for, called chargeable income. So this chargeable income is a composition of 3 things. What are the 3 things? The first item in your answer was the profit or loss before tax, which you picked from where? From the POL. You came and added back all the non-allowable deductions, and you have a total of those non-allowable deductions also put in the last column. So you have 2 figures now. You also came and added all the allowables, and you also have the total of allowables. So you have 3 figures now. The profit or loss before tax, add back the total of non-allowables, subtract the total of allowables, and the figure you have is called chargeable income. So you have your first answer. When you get chargeable income, you cease to use column number 2, and every other adjustment is going to be in the last column. Every other adjustment is going to be in the last column, because you're now going to see the things that are going to be adjusted on chargeable income. Number 1 adjustment on chargeable income is called a carry forward loss. Ladies and gentlemen, in the exam, if they are going to examine you on carry forward loss, it is going to be a free mark, because they are going to give you a statement. The loss carried from the previous period is this. All you need to get the mark is coming and pressing it in the right place. You're not going to calculate it. They are going to give it to you as a line. All you need to know is, where do I press it in the tax computation? And we agree that you press it after your chargeable income. Now, you have removed the carry forward loss. What you have then is the adjusted chargeable income. The moment you have your adjusted chargeable income, it is time now to apply the tax rate. It is time to apply the tax rate. Remember, I am speaking about a company now, and I'm going to show you the things that change when it comes to an individual. And then we'll look at a partnership separately. So for now, I am going to be notifying you of the things that happen on a company and bringing the adjustment that you need for an individual. Now, when you have the adjusted chargeable income, the next thing is to apply the tax rate. Ladies and gentlemen, for a company, you apply 30% as the tax rate and applied on chargeable income. Now, if the chargeable income is the negative, because it is possible that you can have a negative, as you actually get your profit or loss before tax, you add back the non-allowables, you subtract the allowables, that chargeable income that you get could be a negative. When it is a negative, please don't go ahead to apply 30%, because we don't tax losses. We don't tax losses. So don't apply the tax on, if the adjusted chargeable income is a negative, you don't apply. Yes.
I beg your pardon upon the negative thing you have talked about.
I have said that as you actually get the profit or loss before tax, you add back the total of non-allowables, you subtract the total of allowables, you're going to get the chargeable income. And it's possible that that chargeable income could be negative. When it is negative, we don't tax negatives. Yes, you're going to go ahead and remove the carry forward loss, meaning the negative becomes even much bigger. When it comes to tax payable, please do not apply the tax payable. Show a dash, meaning you understand that when the adjusted chargeable income is a negative, you know that that negative cannot be taxed. So don't apply the tax rate. Once you're done with that, the next thing that you actually have to remove from the tax payable, because here you're saying, I have calculated the tax payable by this company. If it is an individual on the tax rate, please do not apply 30%. If you're dealing with a number on an individual, do not apply 30%. That's where an individual changes or has a difference with the company. What do? In your question paper, at the back of your question paper, you'll have individual income tax rates. Those are the rates that you're going to apply if it is an individual. So do not apply 30% on an individual, but rather go to those rates and see where this chargeable income falls so that you can be able to calculate the tax payable on an individual using those rates. So you'll do some side work before you can actually bring the tax payable. When you have had the tax payable, the only things that you're going to remove from the tax payable, one is one that is unique. You might not mind about this because you might even forget it in the exam. But in case you remember it and you're dealing with a person who is employing persons with disabilities that form at least 5% of the employees, those persons that are employing persons with disabilities have a unique deduction. After computing the tax payable, they are also allowed a deduction of 2% of that tax payable to reduce their tax burden because they are employing persons with disabilities. It's very rare, but in case it comes, the sharp ones will pick it because I have actually talked about it. But even if you forget it, I don't know the impact that it will have. Of course, you lose some marks. But the most important thing that you must remember is that after getting tax payable, remember to remove the tax credits. Remember to remove the tax credits. What are some of the credits that you're going to meet? There are only 3 types of credits. And when you see them, you don't put them anywhere else other than at this point. Number 1, there's what you call foreign tax credit. Foreign tax credit is the tax you have paid in other countries because you got money from those countries. So if you have any foreign tax credit, if the examiner tells you that you paid some tax outside Uganda and it's income tax, then you're going to come and remove it here because it's called a foreign tax credit. The other credit that is very common is withholding tax. If you see one of the statements, the examiner is saying, throughout the year, this is the withholding tax that they withheld from you. Then that credit is, you're going to actually remove it from your tax payable at that point. The third credit is provisional tax paid. If they told you that throughout the year you paid some provisional tax, it is the time you remove the provisional tax. My warning and what we have observed through marking is that you see people putting provisional tax, putting withholding tax, putting any other credit within the tax computation, within the add backs or even the subtraction, the less allowables. No. Any withholding tax, any provisional tax paid, any foreign tax credit, only and only comes after you have computed your tax payable. Because you're saying, this is the tax I should have paid, but I have already paid some of that tax in advance. And that is withholding tax, that is provisional tax, and that is foreign tax credit. Now, I want you to close your eyes and see that format flowing. We are saying you're starting with the profit or loss before tax. That figure, put it in the last column. The second heading is add back non-allowables. Where are you picking the items from? From the PO and strictly expenses. By the time you bring an item there, you should be satisfied that this item should not be an allowable deduction. Next heading is less allowables. And I said less allowables is a mixture of incomes and expenses. You only bring in incomes if they are coming from the POL. We said you cannot pick an expense from the POL and bring it under less allowables. The expenses that are going to be there are expenses that you have calculated yourself, or the things that the accountant has not yet knocked off from the POL. Never bring an expense from the POL and bring it under less allowables. You'll be making a mistake, or you'll be giving this person a second deduction. Remember, these expenses have already been deducted from the POL. Those three items give you the chargeable income. From the chargeable income, you remove carry forward loss. After removing carry forward loss, it means you have your adjusted chargeable income. After getting adjusted chargeable income, apply the relevant tax rate. If it is a company, apply 30%. If it is an individual, apply the individual income tax rates, which are at the back of your question paper. And then finally, you have tax payable, and then you can remove the relevant credits. We talked about foreign tax credit. We talked about withholding tax credit. We talked about provisional tax credit. Now, we are going to go back, and I'm going to be highlighting some of the things that I must add back when you see them. I must add back. In other words, I am saying we are now going to start the question. I want the comfort that everyone is going to pick item number 1, which is the profit or loss before tax. Yes. Pardon? I said this 2%. Let me first bring it back. This 2% is a unique deduction, and it is only calculated after you have computed the tax payable. It is only and only applicable if they have told you the person you're calculating the tax for is an employer who employs persons with disabilities, and those persons at least form 5% of the full-time employees. If you're dealing with a company and the examiner is saying this company employs persons with disabilities, and you realize that the number of disabilities or persons with disabilities is at least 5% of the total number of employees, then such employers qualify for another deduction from their tax payable, and it is 2%. So you calculate 2% of the tax payable. You calculate 2% of this tax payable, and you remove it because they are not meant to pay that tax. It is a benefit for them for having employees persons with disabilities. So if you're dealing with a number that has the employer, you have not seen any note to do with persons with disabilities, that 2% is irrelevant and do not consider it. Now, we are going to start earning the marks. Where do you earn the marks from? We said you start from the profit or loss before tax, and I am very sure everyone should be able to see where the profit or loss before tax is coming from. And I want you will not see the examiner calling it profit or loss before tax all the time. So when he changes the naming and he calls it net profit, don't get shocked and say, but I actually looked for the profit or loss before tax and I couldn't see it, so I left it. I am talking about a profit before any income tax is charged. That is what you're looking for by whatever name is called. If it is a profit, take it as positive. If it is negative, take it as negative. The next thing you do is that now you're here. Anything below that profit or loss is useless. So meaning, when you're standing here on the profit before tax, you're looking upwards here. What are you looking for? You're looking for expenses that are considered to be non-allowable deductions. Now, if I look at this, I see, for example, finance costs. I see other expenses. I see administrative expenses. I see distribution costs. And the next cost that I see is in under cost of sales. Those are the only costs that I see. When you're looking at the face of it, you cannot tell a story about what these expenses are. That's why you have to go down where the notes are to see what exactly is embedded. For example, what is embedded in finance costs? What is embedded in other expenses? What is embedded in administrative expenses? What is embedded in distribution costs? What is embedded in cost of sales? Those are expenses. Ladies and gentlemen, the first way to identify the things that you need to adjust is by ensuring that everything that has a note, everything that has, whether you have forgotten or not, everything that has a note ideally has something that must be adjusted in the tax computation. Every item that they have given you a note on, for example, if I see a note on gross revenue, it means there is income that should not be taxed. And therefore, when I find it, I must go to the tax computation and remove it. When I look at other incomes, they are also telling me there are some incomes in other incomes which are not supposed to be taxed. So my role is go to the tax computation and identify them here and go and remove them in the tax computation. When I look at note number 3, distribution costs, because ideally, distribution costs, you would say, these are normal business expenses. Why are they questioning something about them? It means there is something that you must look out for that is a non-allowable deduction. Number 4, administrative expenses. We know that businesses incur administrative expenses, but there is a reason why they have given you a note on administrative expenses. Does it mean that all other items that have no notes have no adjustment? No. Do not cram it like that, because sometimes they can actually put an expense on the face of the POL that is obvious must be added back. For example, if I put depreciation on the face of it, even if I don't put any note on it, you must know that it must be added back. Now, all the examiner wants you to do is look at this POL, read the notes, because the notes are going to be about incomes and also about expenses. Every note that you read, only and only pick items that are meant to go to the PO, rather to the tax computation. If I am reading a note about incomes, it means when I pick an item, I must take it under the allowables. If I am reading a note on incomes and I pick an item, I cannot add it back because in the POL is already added. So when I go to the tax computation, I do what? I subtract it. If I am reading notes on the expenses, because they are breaking down for me the expenses, if I am going to be picking any expense, I must be going to add it back. I cannot be subtracting it because it is already subtracted in the POL. When I read any note on assets, whether the depreciable assets or buildings, I am reminded that I have to go and calculate capital allowances. And the moment I calculate capital allowances, I must take them under less allowables. Are we together up to that point? Okay, so let's now run through some of the common areas that you're going to actually be meeting in your exam. And we're going to start with the add backs. What are the things that you must question when you see? What are the things that you must always add back, and what is the reasoning for adding them back? Number 1, I expect that every student must be able to add back depreciation. When you see the POL and you see any item of depreciation, please add it back. Number 2 is about entertainment expenses. Now, we have so many kinds of entertainment, but there are expenses that are not. For example, in entertainment, we talk about provision of meals, we talk about refreshments, we talk about staff end of year parties, we talk about all the kinds of recreation expenses that you actually incur on your staff. Now, not all those entertainment expenses are allowable deductions, and you must look out for the common ones that the examiner has kept on examining, and I'm going to actually hint on them. Number one, if you've been reading, you must have seen most of the times the examiner asks about end of year staff parties. Anything that is to do with entertainment, for example, end of year staff parties, are non-allowable deductions because they are considered to be general entertainment. So when you see an item of entertainment or meals or refreshment, you must remember that the only time we allow meals, refreshments, and entertainment are in these three circumstances. Number one is when these meals, refreshments, or entertainment expenditure has been provided to staff while undertaking travel in the course of performing their employment activities.
Please take us
For
back to
example,
the
what you
screen.
call, pardon?
Screen sharing.
Oh,
The
I haven't
Excel.
shared this. Sorry. So we talked about depreciation. We are now on entertainment. And I told you the common item there is end of year staff parties. Any kind of celebrations are considered to be entertainment that is non-allowable. And I was saying the circumstances under which you can allow meals, refreshments, and entertainment is when you actually give, for example, subsistence allowance, what we call per diem, to your staff, and they are going to the field. That is allowed. Or when this business you're dealing with is in the business of entertainment, for example, the number is on a hotel, it is on a restaurant, it is on a bar, then you know the expenditures for buying all these items, the sodas, the beers, the dancing, all that is part of their costs ideally that they would be incurring in doing their business. So automatically they become allowable. The other times when you actually allow an expense is when these meals, refreshments, and entertainment expense has been taxed on the employee. We have given you a benefit, but we have gone ahead and taxed you. If we tax you, it means the company can also claim a deduction. Other than that, the general entertainment is not an allowable deduction. That means that if the examiner just puts the word entertainment expense, please go and disallow if they have not given you any qualification to it. It means it is general entertainment. That is one. Number next is expenses related to exempt income. If in a year you earn any exempt income, first of all, we shall say that that exempt income is going to be knocked off in the less allowables. And therefore, any expenditure related to that exempt income also becomes non-allowable. The next expense that you're going to see, and very common, loss on disposal of assets. Ladies and gentlemen, you're going to find in your POL loss on disposal of assets. That loss on disposal is a non-allowable deduction.
Excuse me, sir.
Yes.
Excuse me. Kindly help me and give me some light of what you mean by exempt income.
Exempt income, the list of exempt income is under section 21, and it's a big list. Now, in the exam, definitely they will tell you that these are exempt income. But if you want to know the list of exempt income, please look at section 21. It has a whole list of incomes that we consider to be exempt. And now the law has said you can't tax it. And because we can't tax it, also the expenditure related to that, to generation of that income, can also not be allowed as a deduction. Now, I want you to skip this item of balancing charge. I am going to explain it later, but for now, just skip it for now. The next thing that is very common are donations. Please listen properly. Sometimes they are calling them sponsorships, sometimes they are calling them donations, sometimes they call them different names, but the company has paid or has contributed certain events. They say, for example, you have contributed to an event, you have sponsored Uganda Cranes for a match, so you have given out a grant or you have given out a donation. Now, generally speaking, all donations are non-allowable deductions unless they pass specific tests. So go with the mind that when I see a donation I am going to disallow it until the examiner has given me certain conditions, has told me certain information. If I am given a donation and the examiner keeps quiet or has not added any information to that donation, what do? I add it back, because generally donations are not business expenses. So what are those conditions that you look out for you to say that this donation now passes the test? There are two conditions that must be passed. And if they pass one and they fail on the other, you still do not allow it. What are the conditions? The law has defined entities that you can only donate to for you to pass the test of that expenditure being an allowable deduction. And those entities are only 5. So look out for them, and if they have donated to any other entity other than the 5, automatically disallow the donation. Now, those entities that I'm going to talk about, first of all, must qualify as exempt organizations. And for them to qualify as exempt organization, they must have a certificate of exemption, or the examiner must tell you that they qualify to be exempt organizations. If the examiner has given you just the name of those entities, but has not told you that they qualify as exempt organizations, please do not assume. It is not about the name. It is the name plus the fact that the commission has confirmed that they are exempt organizations. And what are those 5 organizations? Number 1, amateur sporting association. Number 2 is charitable organization. Number 3, religious institution. Number 4, educational institution. Number 5, research institution. But the defining word is they must be not for profit. In other words, whose object is not for profit. Those entities that I'm talking about should not be for profit making. If I am talking about education institution, it is not every education institution that passes. It is an education institution which is not for profit. For example, government education institutions. If it is a private school, it doesn't pass. Now, the condition on those 5 entities is that they must be qualified as exempt organizations, and they only qualify if they have a certificate of exemption, or the examiner has confirmed that they are exempt organizations. Number 2 condition is that if the 5 entities have passed, if the name has passed, and indeed they are exempt organizations, you also test how much was donated to them. How much was donated to them should not exceed 5% of the chargeable income. In other words, if you see a donation and you know that the enter is passing, is about to pass, it is an exempt organization, it is one of the 5, then you wait actually put an item on donation. You first write the donation, but first go and compute your chargeable income. This item called chargeable income, before you make any adjustment. This item called chargeable income. So when you get that chargeable income, you first get the donation that was put in the POL, add it on that chargeable income. In other words, at that point, you're saying, I am assuming that no donation has already been given out, because by adding back the donation, I am getting chargeable income before any donation is given out, because I want to test whether you had sufficient chargeable income to give out the donation that you gave out. So what do? After getting this chargeable income, I first go to the POL, pick that donation that you had deducted in the POL, first add it back on that chargeable income as a side work. Then I get the total of the chargeable income after adding in that donation. And then I calculate 5% of that total. When I calculate 5% of that total, I am only getting the maximum that you are allowed to give out. The maximum that you are allowed to give out. So if you gave out more than that maximum, the excess is what I take to the tax computation and add back. Have we understood that? Can I repeat it?
Yes.
I have said for the donation, you must first pass two tests. Test number one is on the type of the organization. I want to repeat that. Test number two is whether the donation that was given out does not exceed 5% of the chargeable income. So how do you compute the 5%? I said you first do all the adjustments that you need until you get your chargeable income. Don't write the chargeable income in the answer. Put it aside. Remember, at this point, you have not yet added back donation. You're assuming that it's going to pass as an allowable deduction. But now on the side work, you get your chargeable income that you have, which is this one, which is not yet adjusted for anything. Go to the POL, pick the figure of donation, and add it on that chargeable income. By adding it back, you're saying I have disallowed every donation. I am assuming no donation has been given out. Not so. Now, I want to test what maximum donation you should have given out. So I apply 5% on that total. Please mute your microphone. I apply 5% on that total. The 5% becomes my cap. It becomes my maximum. So if I compare that 5% that I have computed with the donation that you gave out, I am able to tell whether the donation is within the cap or above the maximum. And if I find that the donation is within the cap, I do nothing about the donation. I am satisfied that you gave out the donation to the right entity and the amount is also okay. But in case the donation amount in the POL is bigger than that 5%, I am saying that you gave out more donation than what the law allows you. So what do I disallow? The excess beyond the 5%. We get it now. Okay. So that was to do with the donation. It is very common. Please pay attention to it.
Excuse me, Counsel.
Yes, you excuse it.
How do we treat expenses of whereby maybe the company or the individual carried out a corporate social responsibility?
That also falls under the donation. If you carry out a corporate social responsibility, that is not a business expense. So that is also to be added back.
Okay.
Any sponsorships, any corporate social responsibilities, any direct donations, please make sure you test those ones. And if they don't pass that test, please add them back. Yes. Again, that is also entertainment. That is entertainment. Team building expenses, that is entertainment. Please add it back. Anything else? We'll proceed. You're going to actually put all your questions down so that when we actually finish, you ask all the questions on these areas so that we actually spend little time. The next item that is very common, yes, you excuse it.
What about the company retirement fund contributions?
That's a different matter. We are going to look at that. Please don't mix that with anything else. We are going to look at that shortly.
Yeah.
Okay, so we are done with donations. The next one is provision for bad and doubtful debts. Ladies and gentlemen, that goes together with bad debts. There is bad debts and then provision for bad debts. In practice, for you to say that this is a bad debt, it means you have confirmed that you're not going to recover that receivable. Not so. And therefore, you're calling it a bad debt. So a bad debt is considered as a legitimate business expense. Whereas there are conditions that you must satisfy for a bad debt to be allowed as a deduction. In the exam and the past experience is that the examiner does not put those conditions, but expects you to pass the bad debt as an allowable deduction. Now, the opposite of bad debts is provision for bad debts. Ladies and gentlemen, a provision is not yet an actual expense. And therefore, every time you see a provision, please add it back, because we are saying you are only anticipating. You're only anticipating to incur an expense because of the accounting language or the accounting rules. The accounting rules say that if you anticipate a loss, recognize it immediately. That's why we provide for certain future expenses. So a provision for bad or doubtful debts is not an allowable deduction. Now be careful. If the number they have given you is for a financial institution or an insurance company, those financial institutions have what we call both specific provisions and general provisions. Now, the specific provisions of financial institution is an allowable deduction, whereas the general provisions are non-allowable deduction. So if you're dealing with a financial institution, please only add back the general provisions and don't add back the specific provisions. But for other businesses, as long as it's called a provision for bad or doubtful debts, please add it back. Next is, now I want you to pay particular attention. Yes.
Can you repeat on provisions for financial institutions?
I said the provision for financial institutions are categorized into both the specific provisions and the general provisions. And the examiner is going to separate them. So the specific provisions are allowable deductions. The general provisions are non-allowable deductions. So what do? I only add back the general provisions. Got it?
Okay, thank you.
Good. The next item, pay attention. Startup costs can fall under the less allowables, or it can fall under non-allowables. When does it fall under less allowables? When does it fall under non-allowables? We said for you to bring an item under non-allowables, it should be in the POL. Not so. So for you to bring startup costs in the non-allowables, you should be picking it from the POL. Now, this is what you do. First of all, startup costs, you are allowed a certain portion of startup costs. When the examiner says that these are startup costs, the law says that the person can only be allowed 25% of the startup costs in the first year, and then the other percentage in the next 3 years. Meaning, if you have startup costs, you claim them within 4 years. So what do business people do? When I have startup costs, I am interested in claiming them at once. So like you're going to find them in the POL being claimed at once. It seems, or it means, that the accountant will have claimed 100% of the startup costs in the POL. What does the law allow him to only claim? Only 25%. So what are you disallowing? You're only disallowing 75%. So my warning is, if you go to the POL or the notes to the POL and you find an expense called startup costs, sometimes they call them non-recurring costs. Sometimes they call them pre-operational costs. Those costs, if they have been included in the POL, calculate 75% and go and add it back. If the accountant has not claimed any startup cost, but you have an additional note that says, in addition to the cost in the POL, the company also incurred startup costs, but they have not yet been locked in the POL. It means the examiner is telling you, look here, there is the deduction that you must consider, which the accountant did not consider. At that point, you're looking for only 25% of that expense, but this time put it under less allowables, because the law allows it, yet the accountant has not yet considered it. This is the variation. You see the variation? Please understand it. You only add it back if you picked it from the POL. It means they had claimed 100% and you want to disallow 75%. So you calculate 75%, go and add it back. If there is a separate note about startup costs, but we are not claimed in the POL, this time You're saying this expense called startup cost, the taxman allows 25% of it. So I calculate 25%, but this time I put it under less allowables. Yes.
Excuse me, sir.
You do what? You add back all 100%, and then you go and allow 25%. Still you're correct. You can still do that. Yes, please ask.
About the startup cost that I
Yes.
not, does it mean that we allow 100% if at all they are not part of the POL?
If they are not part of the POL, you don't allow 100%. You only allow 25%. In other words, if in the additional notes they have given you startup costs, operational costs, non-recurring costs, you calculate only 25% because the tax law only allows you to claim 25%. And the accountant has not claimed anything. So you only calculate 25% and go and allow it under the heading less allowables. If they were added in, if they were in part of the POL, you're saying the accountant has claimed 100%, yet the law only allows 75, rather 25%. So what do? Go and add back 75%. Or as one of the students has proposed, you can add back the whole of 100% of startup costs that were in the POL, but come and calculate 25% and allow it under the tax computation. Okay, but you still will get 1 mark because that adjustment is 1. So you can't earn 2 marks by just changing the presentation. Okay, next one. Please mute your microphone. Let's mute our microphone so that we have good audience. Next one is called unrealized foreign exchange loss. It means something that is unrealized can also be realized. Now, you're interested in only unrealized foreign exchange loss. If it is realized, please don't touch it. You're looking for unrealized foreign exchange loss. That is what you add back. Because the examiner can trick you and give you these 4 items because they usually move together. And even in practice, they are there. That you have unrealized foreign exchange loss, you have realized foreign exchange loss, you have unrealized foreign exchange gain, and you also have realized foreign exchange gain. So when it comes to foreign exchange differences, we only consider them for taxes when they have become realized. If they are still unrealized, if it is a loss, add it back. If it is income, subtract it, because you're saying they are not yet realized. If they are realized, please don't touch them. Next is, this one is now the common one. Expenditures or losses of domestic or private nature. Now here you use common sense. Please use common sense as much as you can. The best rule for allowing deductions is that these deductions must have been incurred in generation or production of income included in the gross income. The reason why we do that is that we know that in practice, people usually mix their private expenses, people mix their domestic expenses into business expenses. You have an MD who goes to Serena, enjoys himself, and in the morning brings you a receipt. Please capture that. You have an MD who goes to the supermarket shops for his home and then comes and says, please capture this. You have an MD who actually receives a water bill from home, garbage collection from home, he has paid the school fees, and he wants all the bills to actually be on the company, especially the companies that are managed by individuals, because usually they don't separate them. For them, when they go and incur their own expenses, they have bought fuel for their vehicle, they have actually paid school fees for their children, they have paid house rent for their accommodation, they have paid all sorts of expenditure. They have gone for a holiday with their families. They want you to come and capture those expenses, and I'm very sure you see them in practice, some of you that are accountants. Now here, we are looking for expenditures that we consider to be private or domestic in nature. In practice, these are some of the expenses that you're going to see in your exam. Number one, example, school fees. 2, empties personal expenditures. 3, funeral expenses. 4, holiday expenses. 5, sponsorships, private sponsorships. Subscriptions to non-professional clubs and associations. They have subscribed to Rotary, they have subscribed to the gym, they have subscribed to Kampala Club, they have subscribed, all those. They have sponsored your member of parliament, they have sponsored some Ghana, they have sponsored Uganda Cranes, they have all these corporate social responsibilities that we're talking about, or someone asked. All those fall under the private expenses. We have things like bribes, we have things like general expenses, and some of these expenses are expenses that you're not going to get supporting documents. So when we're auditing you and we find an expense but you cannot support it, definitely we knock it out because we are saying this is not a business expense. Dividends, shareholders, etc. All those are expenses that have been examined before that you're going to see again. And we call them expenses of domestic or private nature. This even includes, for example, your transport to and from your homes. You have seen examples where they say the company pays staff their transport to and from their homes. That is also considered a private expense. Or they have bought you clothing. Clothing is only allowed if this clothing cannot be worn outside work. If they bought you uniform, if they bought you corporate wear is this that I'm putting on. I can't go out now in a party with this Capital College t-shirt because this is a corporate wear. So the only clothing that can be allowed is the clothing that can only be worn at work. For example, the overalls or what you call the personal protective gear. That is what is allowed. But if they go and bought you, for example, Uganda Cranes jerseys, they bought you suits. Some of the entities, like some of these professional firms, the moment they recruit you, they give you some allowance to go and change your wardrobe. So such costs are not part of the business costs that we allow. So watch out, because that is where your biggest common items come from. Expenses of domestic or private nature. This is where you also see education that leads to a degree, education that is not relevant to your employment. That is where we also pick it, because we find it as a private expenditure. Please watch out that it is very common. The next expenditure that is very common, and this one they do it as erroneous to assess whether the student is capable of knowing that capital expenditure does not go through the PO. So you're going to see expenditure of a capital nature. Expenditures of a capital nature is that they bought an asset or they incurred an expenditure of a capital nature, but you're finding it in the PO. All expenditures of capital nature should be where? All expenses of capital nature should be where? In the balance sheet. Because those result into assets. So if you see any asset, they purchased an asset and then the cost is in the POL, you know that that is a cost of a capital nature, and you must. Now that one gives you 2 marks. Because the number one is that you must add it back. Not so? After adding it back, ask yourself, what is the capital allowance for this asset? Because every asset that you have, whether tangible or intangible asset, has a relevant capital deduction unless it is land. But all other assets, if you find an expense of a capital nature in the POL, think about the 2 marks and how you're going to earn the 2 marks. Mark number 1 is for adding it back. You're adding it back because you're saying this is an expenditure of a capital nature and it shouldn't have been in the POL. Mark number 2 is for taking it to the relevant capital allowance and calculate the capital allowance on it. Because if, for example, it's an equipment, you know it's going to be in the wear and tear. If it is a building, you know you're going to calculate IBD. So you have added it back, but you also know that you have to give it capital allowance. The next expenditure that you're going to see, which is not very common, is, for example, when they tell you a company suffered a loss. For example, burnt stock, lost stock, etc. You have suffered a loss. A loss is supposed to be an allowable deduction. But if that loss is insured, then you cannot claim a deduction because we can't compensate you twice. The insurance firm has already compensated you, so you can't come and claim that loss any more. So any loss that is insured becomes a non-allowable deduction. The next warning I was making is when you pay any tax, yes. Someone is asking, what if the insurance cover doesn't cover the total loss? You got a loss of 100, the insurance is only covering 80, your loss is only 20. So it means you're only going to allow only 20 and disallow rather 80 if they had claimed all the 100 in terms of loss. So they made a loss of 100, but they have told you that the insurance company is going to cover only 80 million. It means that 80 million is what you're going to disallow because they have already recovered it. Okay, the next one is income tax payable in Uganda or in a foreign country. Please, when you pay tax, that is not an allowable deduction. Whether you have paid pay as you earn, whether you have paid income tax, whether they have given you an assessment, sometimes when they audit you, they audit you and give you additional assessments. When you're preparing your income tax returns, you want to actually come and claim that tax that they have charged you. That is wrong because tax cannot be claimed in tax. So anything to do with withholding tax that they charged you, anything to do with provisional tax that they charged you, even stamp duty cannot be an allowable deduction because we cannot allow you to claim tax that we have charged you. Any income carried to a reserve fund, that is common on provisions. Gifts made to individuals, if you give any gift to your staff, but you have not taxed them on that gift, then you can also not claim any expense. So if you give out any gifts, it's like entertainment. We cannot give you any deduction. Now, this one is very common. Fines or penalties or bribes. Fines or, I am very sure as you've been doing practice, you have seen almost all questions. They have an item of fines and penalties. Please, when you find fines and penalties, add them back. The next one is, I think this is the question that one student was asking about the contribution to retirement fund, for example, NSSF. Now, when an employer contributes NSSF, what percentage do they contribute? 10%. But in total, how much gets into your NSSF? 15%. So where does the 5 come from? From the employee. So when the employer is claiming for NSSF contribution, should they claim the 15%? No, they can only claim the 5, rather the 10%. So watch out. If the examiner has told you that there is an NSSF contribution and has said nothing, then you assume that is only 10%. But if they go ahead and say this contribution to NSSF represents the 15%, they are telling you calculate the 5% and disallow it. Now, the problem students have is that they don't know how to calculate the 5% of the 15%. When they give you an amount, for example, they say the contribution to NSSF is 10 million. And this 10 million represents 15% of the NSSF contribution. it means you're going to calculate 5% of the 10 million and disallow it. And when you're calculating that 5%, you get 5 out of 15. Get 5 out of 15 times the 10 million. That's when you're going to get it right. If you get 5 directly in 10, you get it wrong. I hope you're getting it. Please don't miss that. The next one is life insurance premiums. Ladies and gentlemen, all the other insurance to staff is an allowable deduction except life insurance. Now, what are some of the insurance you're going to see? For example, there is group personal accident, that is an allowable deduction. There is medical insurance, that is an allowable deduction. There is professional indemnity, that is an allowable deduction. The only time you're going to disallow insurance is life insurance premium. So if they tell you that they paid life insurance premium, please make sure you add it back because it's an unallowable deduction. The next one is alimony or allowance paid under any judicial order or written agreement. That is not very common. The next two items are very common. Please open your eyes to them.
Excuse
These
me,
two are
Council.
very, very common. Yes?
The deposit protection fund made by banks, is it allowable or non-allowable?
That is allowable.
Okay.
It is a legal requirement. Okay. These two that I am going to talk about, you like it, find them in your exam. Because it's the order of the day now. Number one is to do with the team. If you purchase anything, if you incur any expense in any single transaction and that expense is above 5 million, but the supplier or the service provider has no team, that expense becomes non-allowable. Whether it is 10 billion, whether it is 6 million, whether it is how much, as long as the supplier has no team, all the expense becomes non-allowable because it is above 5 million and it is from a person without a team. Please watch out for that. Number two is about IFRS now. If you deal with a person, and previously it was persons who are registered for VAT that were only required to give you IFRS invoices. And of course, that is what is applicable to your exam. If they tell you that this person is registered for VAT, but they do not give you an IFRS invoice, e-receipt, or e-invoice, then that expense also becomes non-allowable by whatever amount, whether it is 100 shillings, whether it is 10 million. Now, the change that has happened, but which is effective 1st of July 2025, is that we have expanded the IFRS usage beyond the persons who are registered for VAT. So almost everyone now is meant to give you an IFRS receipt or IFRS invoice. The absence of that e-invoice or e-receipt means that you cannot claim the expense and whatever amount it is. So for this year, starting from July 2025, if we are going to audit you in the next years, it means for this period, for example, the year 2025-2026, is going to be easy to audit because all we are going to be doing is that generate your IFRS information expenses, and whatever is not in the expense in the IFRS, we disallow it. And the moment we disallow it means we tax it. Every time you disallow an expense, the result is 30% of that expense that you have disallowed. Now, for your exam, of course, you're not going to apply that provision of the law because it only came in on 1st of July. But what is going to be applicable to you is that if there is any expense from persons with registered for VAT, but they are not supported by IFRS, e-receipt or e-invoices, then that expense becomes non-allowable.
For you, you know
Okay?
them.
Please mute your microphone. Please mute your microphone. I had talked about provisions. I won't repeat them. The next thing that is easy is amortization. Now, I want you to pay particular attention. We said depreciation is added back, not so. For the accountants, when they are calculating depreciation, they calculate it on what? They calculate it on all physical assets, not so. All tangible assets, including buildings, including all other assets except land. Isn't that what the accountants do? Now, when you add back depreciation, remember you have to calculate the depreciation for the taxman. And this depreciation comes in form of wear and tear and IBD. So the depreciation that you added back, you're going to substitute it with the capital allowances known as wear and tear and also IBD. Once you calculate them, you allow them because you disallowed the accountant's depreciation. You're substituting them with IBD and wear and tear allowance. What about amortization? What do we amortize for accounts? We amortize intangible assets. Now, also amortization is a non-allowable deduction. The amortization calculated by the accountant is a non-allowable deduction, just like we said, depreciation. But what did you substitute that amortization with? The tax law has also allowed an allowance on intangible assets. So by the time you see an amortization in the POL, it means this person has an intangible asset. So what do? Add back the amortization, but come and calculate the allowance on intangible asset. How do you calculate the allowance on intangible asset that is allowed for tax purposes? You get the capital expenditure of the intangible asset over the useful life. That you get, you come and allow it as the capital allowance on intangible asset. I want to repeat this because these are free marks, ladies and gentlemen. The mark of depreciation and the mark of amortization is these are free marks. All you have to see is I see depreciation, I see amortization, I add them back. Don't stop there. Because the fact that you've added the accountant's depreciation and amortization, the taxman is also saying, look here, the depreciation was representing the cost of the assets, cost allocation of the assets. I am not going to deny you that. I also want to give you an allowance, but I want you to calculate it using tax rules. So for depreciation, I want you to substitute it with wear and tear allowance and also IBD. For amortization, I want you to substitute it with the capital allowance for intangible assets. So how do I calculate the capital allowance for intangible assets? First of all, I must get the cost of that intangible asset. How much did we incur on that intangible asset? And I must also be able to know the useful life of that intangible asset. So that when I get to the capital expenditure over the useful life, then I get the allowance that I'm going to allow on that intangible asset. And I take that capital allowance under less allowables. So I added back amortization, but I am allowing capital allowance on intangible asset. Now I want to warn you, sometimes they put an expenditure in the POL, which is meant to develop an intangible asset. For example, brand. But this intangible asset has not reached a point where it is recognized as an intangible asset. Just like if you're putting up a building like this. If this building is not yet put to use, you can't claim any expenditure on it, yet you're actually spending. So if I found such an expenditure in the POL, what do? I disallow it, but I am not giving you any capital allowance because it has not yet qualified for the capital allowance. The same applies to intangible assets. If you found, for example, an expense in the POL, say for example, for developing a brand, and has not yet matured to become an intangible asset. And how do you know? It has not been allocated any useful life. You see the expenditure, but there is no useful life. It means Whereas you're going to disallow that expenditure which was in the POL because it's capital in nature, you're not going to calculate any capital allowance because you don't have any related useful life on that asset. So it's possible you can incur a capital expenditure, but this capital expenditure has not yet materialized into paying or into qualifying for a capital allowance. And I gave you an example of a building. If I got all the construction costs and put them in the POL, it means I have put them in a wrong place. So what do? I add them back. Then I go and ask, has this building reached the point where I should be giving it IBD? At what point we give a building IBD? If it has been put to use. If it has not been put to use, it means this building cannot qualify for IBD. So I only add back the capital expenditure, but I cannot give it IBD. The same applies to intangible assets. Okay, next
Excuse me,
is,
sir.
of course,
Excuse me,
yes.
sir. If they've said the building is ready for use, but they haven't yet put it in use, does it still qualify for IBD?
As long as it is ready for use, either ready for use or put to use, because that's what it means. As long as it's ready for use, it's available for use. That's the language actually. Okay. So I've talked about amortization. The same applies to impairment of assets. Again, that is an accountant's expense, but it is not an allowable deduction. These other ones are minor. I want to talk about this one. This one that I've highlighted. Total expenses purely related to rental income. Ladies and gentlemen, it's very, very, very common. You actually to do a number where in the POL, they have included these two items. Rental income in the incomes, but when it comes to expenses, they also indicate to you the expenses that were incurred in generating that rental income. All those two items go to the tax computation. Rental income is going to be removed from the tax computation. Expenses related to that rental income are going to be added back. Hello? When you see rental income in your POL, also look for the expenses that were incurred in the production of that rental income. And both of them must go to the tax computation. Rental income is going to be removed while the expenses in production of that rental income must be added back. Don't remove one item and leave the other. And the principle we are using is that rental income is taxed separately. That means, again, please watch out for additional marks. It means when you see rental income, don't forget to calculate rental tax on the side as one of the workings. If you see rental income, these are the 3 steps you take. Step number 1, you go to the tax computation and remove the rental income. Step number 2, go to the tax computation and add back the expenses related to rental income. Step number 3, calculate rental tax separately as a working. I hope you get that. So, any other non-allowable deductions that you might actually get to know, and the only way you can actually get a non-allowable deduction, I told you, the principle is you can only allow an expenditure or loss that is incurred in the production of income included in the gross income. So if you see any expense that you believe and your heart is telling you, but how is this really being used in generating income? That is where you actually have to deal with. Now, for the guys doing paper 17, please look out for expenses, for example, that are coming from your group entities, which are charged, but the services were never provided. So you look out for expenses such as management fees, such as group recharges, such as procurement costs, such as finance costs, but the examiner has notified to you. Watch out the note given to you by the examiner. I could tell you management fees. But in the notes I'm telling you, there was no evidence that these services were provided. And therefore, I'm giving you additional information that definitely that cost was never incurred. So watch out for such languages. Now, again, I want you to see this. I am going to show you on the face of the POL. There is this line. There is this line. This one. Finance costs. What is always in the finance costs? Largely it is interest. Not so. Now, every time you see a note on that line called finance cost, the examiner is testing about 3 things. Please remember them. Every time you see a note on finance cost, please remember these 3 things. Number 1, there is interest that we call normal operational interest. How is it normal? I go to the bank, borrow money, and I am injecting it in business in my operations. That means that interest that is arising is normal and therefore allowable deduction. I do nothing about it. But you're also going to be given a note that interest relates. Yes.
We first go back about the interest you have talked about.
The interest. I am on the interest. So where do you want me to go back? I have just started it.
That's your first statement.
Pardon?
Your first statement.
Okay. I am saying this line called finance costs. Are you able to see where I'm pointing?
Yes, I'm seeing it.
Okay. And I have said when you find a note on those finance costs, remember these 3 things I'm going to talk about. Number 1, this finance costs could have both allowable and non-allowable components. What are you looking out for? You're looking for only the non-allowable components. What are the allowable components? Is when the examiner tells you this was interest incurred on, say, for example, a loan that was used to finance the operations. That is normal interest. The way you go to the bank and pick money, you're paying staff salaries, you're importing goods, you're buying those are normal operational costs. However, in that interest, the accountant could also include interest that we call borrowing costs technically. What are borrowing costs? I go borrow money from the bank, but I am coming to use it in the construction or acquisition of a non-current asset they call a qualifying asset technically. If I borrow money and I am constructing a building like this, or I am incurring a cost of a capital nature, that interest on the loan is technically called borrowing costs. And in nature, it is capital in nature. And because it is capital in nature, it can't be in the POL, but rather should be added to the cost of that asset. So if they have included it in the POL, you must go and remove it by adding it back. When you add it back, ask which asset was it relating it to. If it was a building, get that interest, add it on the cost of the building for purposes of getting the total capital expenditure on that building. Because that type of interest is capital in nature. That is second category of interest. The third category of interest, and it is tested now both at paper 11 and paper 17, but largely at paper 17, is what we call interest on group loans. Interest on group loans. If you're dealing with a number and they have put a note on finance costs, and they have told you that this is interest on the loans coming from either your parent company, your fellow subsidiary, to a subsidiary. It means the examiner is saying this interest must be tested for interest capping. Have you heard about interest capping? Interest capping is provided for under Section 25 of the Income Tax Act, but I want to simplify it for you. What is interest capping in the first place? Interest capping means that if you get loans from the group entities or the entities that are in the same group and you're exchanging loans, that interest that you incur on those loans cannot be given to you in full. We normally test it through interest capping equation. And I want you to master, are you going to write that equation now? We test for what we call the earnings before interest, tax, depreciation, and amortization. It's called earnings before, or tax earnings before interest, tax, depreciation, and amortization, EBITDA. But how do you test, or how do you know that earnings before interest, tax, depreciation, and amortization? This is the formula. And the reason why you're applying the formula is that at the back of your mind, you're saying, this interest that they are claiming in the POL could be in excess of what is allowed to be claimed because of the interest is coming from the group loans. So we try to limit it to a certain level. And how do we calculate this certain level? We first calculate what we call the earnings before interest, tax, depreciation, and amortization. How do we get the formula? Please write. We start from chargeable income. We start from chargeable income. That chargeable income that is not yet adjusted. So the first line is chargeable income. We add back these items. We add back these items. Number one, we add back that interest that we are picking from the POL. We are adding back that interest that is picked from the POL. The second item that we add back is the wear and tear allowance. The next item we add back is IBD. Now, those two items represent the depreciation, because we say we are looking for earnings before interest, tax, depreciation, and amortization. So the reason we added back those wear and tear and IBD is because we are adding back the depreciation that we had allowed in the tax computation. So we add back the wear and we add back the interest, we add back the wear and tear, we add back the IBD, and then we also add back any capital allowance for intangibles. And it represents amortization. The assumption is you had subtracted them in the tax computation. When you're doing the tax computation before you go to chargeable income, you had an item of wear and tear, you had an item of IBD, you also had an item of capital allowance for intangible assets. And you're saying now, I am looking for the chargeable income, what we call earnings, before interest. I am adding back interest, which they had knocked off in the POL. Before tax, of course, I have not applied any tax at the point of chargeable income. Before depreciation, the depreciation I had allowed in the tax computation is only wear and tear and IBD, so I'm adding them back. And then before amortization, the only amortization I had added back is, rather the only amortization I had allowed in the tax computation is the capital allowance on intangible asset. Now, I am getting a figure called earnings before interest, tax, depreciation, and amortization. Do you have that figure now in your formula? How did you get it? We go to the chargeable income. Where did I get the chargeable income from my computation? I added back interest. Where am I getting interest? From the POL. I added back wear and tear allowance. Where did I get it from my tax computation? I added back IBD. Where am I getting it from my tax computation? I added back any capital allowance related to intangible asset. Where am I getting it from my tax computation? The figure that I have now is called earnings before interest, tax, depreciation, and amortization. Once I get there, I apply 30% of that figure. Apply 30% of that figure. Have we applied 30% of that figure? Now, what I have is the maximum amount of interest that someone is allowed to claim. That 30% that you've calculated is what we call interest happy. In other words, it is the maximum that someone should be allowed to claim if they have any group loans or interest arising from group loans. Now, that figure, you're going to compare it with what? What are you comparing that figure with? You're comparing it now with the other interest you are querying. That interest that you had added back is what you're actually comparing with that 30% now. And all you're looking out for is, does that interest go beyond the 30% I've calculated? I have already put a seal. The seal was 30% of the earnings before interest, tax, depreciation, and amortization. Now, that figure that I have calculated at 30% is the cap, is the ceiling. I now compare it with the actual interest that I saw in the POL. If the interest is over and above that cap, that excess is what I am going to disallow. That excess is what I'm going to disallow because it has gone beyond the interest cap. So every time you see a note on finance cost, please remember those three things I've talked about. So we go back to our, yes. Pardon?
Yes, I was asking, in case you have the question and it has like interest on something
Just a second online, there is a physical question here. The one asking online, please just a minute. There is one asking in the physical class. Just a minute, I will come back to you. Yes. Yes. No, you're mixing them. You're mixing two now. You're mixing income tax computation and employment computation. So the housing benefit comes in employment computation. So here we are calculating now income tax computation from business. That now discussion of housing is in the employment computation. But this time we are now looking at income tax computation. Thank you. The one online, please go ahead and calculate and ask.
Yes, I was asking, sometimes you find you have a question whereby you have a maybe like management fees, and then there's interest. Like you have the interest, the bid for interest on the board, but then you also have interest that is being paid maybe for a bank, that the company is paying to a bank. When you're computing the company, do you bring both the interests in this computation, or you only concentrate on the interest on the group loan?
You only bring the interest on the group loan and not the whole interest, because the one that you're trying to test is the interest from the group loans.
Thank you.
Yeah. Okay, yes. If the interest in the POL is less than the 30% you've calculated, it means they have claimed the correct interest. In other words, they have not claimed any excess. You're only concerned if there is any excess. Because when there is an excess, that's when you're looking for the amount to disallow. If it is not excess, then the whole of it passes. In other words, you don't touch it. You only touch it if there is an excess, and you're only looking for that part of excess. Okay? Okay, ladies and gentlemen, let's now look at the incomes, rather the allowables. Let's allowables. Now, before you even enter the exam, you can always know, especially when it comes to the incomes, you can always know the kind of incomes that when you see them, don't even ask questions, whether you understand why you're adding, why you're subtracting them or not, but when you see those incomes, just go ahead and subtract them. After the exam, you understand these things. We are now going to list all the incomes, all the possible incomes, that when you see them, and you're saying you're seeing them from where? You're seeing them in the POL. The moment I see those incomes in the POL, I must go to the tax computation and remove them. So number one income is called exempt income. Exempt income. If we see any exempt income in the POL, such as the pension, for example, please don't even think. Just go and remove them. Income number two is rental income. If you see rental income, remove it. Income number three is profit or gain on disposal of assets. Please remove it. Income number next is unrealized foreign exchange gains. Please remove it. Income number next is reduction in provision for bad and doubtful debts. Remember, every time there is a decrease in provision, the accountant recognizes it as income, yet it is not actually actual income. So I will repeat them. Number one, exempt income. Number two, rental income. Number three, profit or gain on disposal of assets. Number four, unrealized foreign exchange gains. Number five, reduction in bad or doubtful debts. The next income that you will look out for is what we call deferred income, or income received in advance. They have told you your year runs up to 31st of December 2024, but they told you that there's money that was put on your account, but the services are yet to be delivered, which are going to be delivered in January 2025. If any income is received by you, but you have not performed the service, you have not delivered the goods, you have not done your performance obligation, that income is received in advance and it is not yet your income, because someone is still demanding your performance, and therefore that income is not yet earned. Any income that goes beyond the 12 months becomes income received in advance, and technically it's called deferred income, which is now not yet due for tax. So if you see it, please go and remove it. Now, I am going to speak about income that you cannot forget, and it will always come in one way or the other. You'll find a line in other incomes, income of this nature. This is income that has suffered withholding tax as a final tax. This is income that has suffered withholding tax as a final tax. Now, be careful. When you're dealing with a company, the only income that is relevant in the hands of a company is interest on treasury bills and government securities. Is interest on government securities, treasury bills and government securities. Any other income, please don't be tempted. But if it is an individual, that income is expanded. The income that suffers withholding tax as a final tax is expanded in the hands of an individual. It includes these four things. Number one, if you're dealing with the number of an individual, interest on treasury bills and government securities, interest from financial institutions, say for example, fixed deposit accounts, commission on airtime and airtime distribution and mobile money agents, dividend payments. All those four incomes are relevant in the hands of an individual. But the only income relevant in the hands of a company is only one: interest on treasury bills and government securities.
Can you repeat those names?
I am saying, when you're dealing with a number on a company, which is likely to be your number one, if it is on a company, the income that suffers withholding tax as a final tax, which you should pull out of the POL and bring to the tax computation, is only income on treasury bills and government securities. Never be tempted, and I've seen the examiner tempting you by giving you interest on fixed deposit accounts, and then the student is quick to go and take it to the tax computation. If it is a company, you have branded. So the only income in the hands of a company that suffers withholding tax as a final tax is interest on treasury bills and government securities. But if you're dealing with the number of an individual has four categories of incomes under that section 139. And what are those categories? Number one is interest on treasury bills and government securities. Number two is interest from financial institutions, for example, fixed deposit accounts. Number three is commission on airtime distribution and mobile money services. Number next four is dividend payments or dividend income received. That is in the hands of a resident individual. So do not mix those two, the individual and the company. And I will repeat, it is only one set of income in the hands of a company that suffers withholding tax as a final tax that you're going to be picking from the POL and bringing it to the tax computation. If you see interest on fixed deposit account and you're dealing with the number of a company, please don't take that interest to the tax computation, but rather calculate 15% of that income and take it as a withholding tax credit in the tax computation. I repeat this. Common items that are tested on a company is that they give you one of the incomes as interest on fixed deposit account. And I am saying that that interest suffers withholding tax of 15%, but it is not final. And therefore that interest on fixed deposit account is not going to be taken to the POL, rather to the tax computation. But you must go ahead and know that it has already suffered some withholding tax at 15%. So calculate the 15% of that income, and you're going to use it as part of the withholding tax credits that you're going to give to this company, because you're taxing the income again. You're leaving the income there, and you're saying, I am going to tax this interest on fixed deposit account, but as I tax it, I am aware from the tax law that it has already suffered some withholding tax, which is not final. It is creditable. So I calculate the 15% of that interest, and then come when I am done with my computation, after getting tax liability, it is one of the withholding tax credits that I'm going to allow you, because I am leaving the interest income on the other side. Any question on that income? You cannot do an exam without that set of income under section 139. The income that has suffered withholding tax as a final
15% deduction.
Pardon?
The interest. Come again on the interest.
I have said that what I have seen the examiners test, especially on company numbers, is that they will give you income on interest on treasury bills and government securities, but on top of that, they will also give you interest on a fixed deposit account. Now, what the students do is that sometimes they take all these incomes to the tax computation. That is wrong. When they give you that scenario, you only take the interest on treasury bills and government securities, but don't touch the interest on fixed deposit account. Now, the way you're going to the impact on the interest on fixed deposit account is that that interest, when the bank was paying it to you, they paid it to you less withholding tax of 15%. So you as a student doing computation or even in practice, if you did not touch the interest on the fixed deposit account, it means it is becoming part of the income that you're going to tax. Not so. And because you're taxing it the second time, if you don't allow this person the withholding tax they suffered in the bank, you have taxed them twice without giving them their credit. That's why you have to calculate 15% of that income and take it to the tax computation, but now it is in the form of withholding tax credit. And we said withholding tax credit comes after you have computed the tax payable. Do we get it? That was on the side of the incomes that you must watch out to bring to the tax computation under less allowables. And we are saying you're bringing them here because they were in the POL. Now, over and above the incomes, we say there are also other deductions that come under less allowables. What are those deductions? Number one, capital deductions. What are the capital deductions you must look out for? Basically, there are a number of capital deductions that you're going to look out for. Number one, yes. When they give you net, you must first of all turn it into gross. Because if you don't turn it into gross, you'll be calculating it on a wrong base. Because withholding tax is calculated on the gross. So if they have put in brackets net, you must first of all gross it up by getting that figure divided by 15%. When you divide it by 15%, you get the gross amount and then apply 15% to get the withholding tax that you want to allow this person. Thank you for that question. Now, I have said, I come again. Men don't come again, they come once. But I'm saying.
We didn't hear the question.
You didn't hear the question. The question was asking, what if that income on fixed deposit account was net? Sometimes they put in brackets net, sometimes they put in brackets gross. What do you do? If it is net, you first gross it up. How do you gross it up? Because by the time it becomes net, it means they had subjected it to 15%, meaning that amount is now standing at 85%. You must take it back to 100%. As a side work, you get that income which was on net and divide by 15% to bring it back to gross. And then on that gross, that's where you apply the 15% to know the withholding tax that was calculated on that gross, which you're going to allow as a credit in the tax computation after getting the taxable income, after getting the taxable, rather the tax payable. Okay, now we are done with the incomes under less allowables. We are now going to look at what are the possible deductions under that heading of less allowables. And the warning was, you don't pick an expense in the POL and bring it there. You're only bringing the deductions that are allowed by the tax law, but were never considered by the accountant. So what are these? Number one capital deduction that you're looking out for is the wear and tear allowance. The other name of wear and tear allowance is depreciation allowance. And therefore, it means you must draw the wear and tear schedule that we are going to see shortly. Number 2 capital deduction that you're looking out for is industrial building deduction. Industrial building deduction meaning you were given a building and you have to calculate the IBD. So before you get into that exam, know how IBD is calculated. When you calculate it, bring it under less allowables. Number 3 is startup costs. I've already explained startup costs if they were never charged to POL. Number 4, cost of intangible asset or allowance for intangible assets. Remember it. Number 5 capital deduction that you can actually be aware of is what we call horticulture plant or greenhouse. Horticulture plant or greenhouse, all of them get 20% of their capital expenditure, but they are capital deductions or their capital allowances. So remember those. Remember wear and tear, remember IBD. How do you know that you're supposed to calculate wear and tear? You will see a note that has classes of assets. There the examiner is telling you calculate wear and tear. How do you know that you're going to calculate IBD? The examiner will give you a note on buildings. How do you know that you're going to calculate startup costs? The examiner will give you a note on startup costs. How do you know that you're going to calculate allowance of intangible assets? The examiner gives you an intangible asset with the capital expenditure plus the useful life. How do you know that you're going to calculate capital allowance for horticulture plant or greenhouse? The examiner will tell you there was a horticulture plant or a greenhouse. And we said the capital allowance for horticulture plant and greenhouse is just 20% of the capital expenditure. The other deduction that you're going to see is scientific research expenditure if it was never included in the POL. The other expenditure that you're going to see is minor capital equipment. Minor capital equipment simply means it is a capital asset which can work on its own, but its cost is less than 1 million. So if among the assets, the additions during the year, if there is a note and say, the additions during the year include the following, and one of the assets is an asset whose cost is less than 1 million. Even if you bought, for example, you bought 1,000 furniture or chairs, but each chair is 700,000. But when you aggregate them, they become 10 billion. That 10 billion still becomes minor capital equipment because each of the items was less than 1 million. We don't look at the aggregate, we look at each of the items. So do not say, Julius told me minor capital equipment must be less than 1 million. No, it is 1 million if it is one, less than 1 million if it is one item. If there are many, the figure can even be 10 billion as long as they have told you each of the item is less than 1 million. Also, that qualifies as minor capital equipment. So that asset is not going to be taken to the wear and tear schedule, but rather you're going to bring it directly as an allowable deduction under less allowables. I will also talk about a balancing charge, rather balancing allowance, just like I'm going to talk about a balancing charge. But when I talk about allowance, a balancing allowance, know that it's going to come under less allowables. And then any other allowable deductions not included in the POL. I should actually be able to add this. Any other allowable deductions not included in the POL. Please, please, please never bring, you can actually be saying, you see, when you're thinking, you say this is allowable, this is non-allowable, and then you're going back to the POL and say, whatever I actually put as allowable, I'm also bringing it. You will be burning your hands. Please never bring any expense that is allowable from the POL and bring it here in the tax computation. You'll be doing it the second time. Okay, so that is it. I am now going to, you're now going to stretch for about 10 minutes. Come back, we go through the wear and tear schedule. we see how IBD is calculated, and then we'll be done with number one in terms of the company, and then we'll do a number, rather we'll look at a number on partnership. Because I said it is either company, a partnership, or an individual. So we are now about to finish the company. Definitely, all the principles that we have picked for a company apply on the individual, also apply on the partnership. Whatever we have said is non-allowable still remains non-allowable. Whatever we have said is allowable also remains allowable. I am only going to make a few comments when it comes to an individual and when it comes to a partnership, so that we know those three are complete, because they are going to form your number one. So we're going to come back here at 10 minutes past 11. Please run, get something that you can put in your stomach, and then we can come back in the next 10 minutes.
kimu kyonna mubuuza.
Okay, so shall we come back? Guys online, confirm that you're there.
Yes, we are here. We are back.
We are back. Okay.
I would like to ask something.
Please go ahead.
You said that if those allowances, the capital allowances are in the profit or loss statement, we don't compute again.
First of all, you can never find those capital allowances in the POF.
Even startup costs?
No, startup costs, you find them. If you find, I have already explained how you deal with startup costs.
Yeah, I know how to compute it, but in case it's in the P&L statement or the research expenditures, scientific research expenditures, things like those ones.
If they are already there in the POL, they have already allowed them, so you can't allow them again.
Okay.
Yeah.
So if they're in additional information,
If
we
they are in
compute.
additional information, but they are not part of the POL, then you have to consider them in your tax computation because the tax law allows them. Allows scientific research expenditure, allows 25% of startup costs, etc.
But then there are circumstances where you find withholding tax already in the P&L. Do I still go
If you
aside
find
and I
withholding tax in
recompute
the
it?
POL, please go and disallow it. If you find withholding tax in the POL, if you find VAT in the POL, if you find any form of tax in the POL, please go and add it back.
Okay.
Yes.
Thank you.
You're welcome. Okay, so
Excuse
quickly,
me, Nancy.
let's look at the way until schedule. I explained the things that you must know under. Yes.
Okay, you talked about on the taxes.
I
There
talked
is
about
where
what?
you find. You talked about the withholding tax and the any provision, but here there is a
Yes.
question on VAT.
Yes.
It says the VAT paid on imported services. Are we add it back or we are?
The VAT on imported service is a unique transaction. And because the VAT on imported services, the taxpayer has no corresponding credit in VAT, we normally allow it for income tax purposes. So if it is VAT on imported services, please allow it and don't touch it. It is a legitimate cost. Thank you for asking that, because VAT on imported services is very, very unique. But when you find an expense called VAT on imported services in your expenses, please allow that. It's an allowable deduction. Don't touch it, don't add it back. But if it is VAT on importation, by the way, VAT on importation of goods is what we are talking about. If it is on imported services, please don't touch it. And the reasoning is very simple, because the VAT on importation is claimable in the VAT returns. That VAT you pay at customs, you will claim it as input VAT. But the VAT you pay at importation of services is not claimable, and therefore whatever VAT that is not claimable in the VAT return becomes part of the cost of the part of the expense. Are you getting the reason?
Yes. Thank you, sir.
Good. Okay.
Excuse
Now,
me, Council.
yes, you excuse it.
I wanted to ask about the dividend. You said under companies, we only consider the interest on treasury bills. What if they
Yes.
have given us also the dividend, gross dividends received from a sister company?
If the dividend is coming from a sister company and the sister company owns more than 25%, that's when it becomes exempt. So you're bringing it in terms of exempt income.
Okay.
Yeah.
Council,
Yes.
I need some clarity on the rental, when you're calculating rental income for companies. That 50%,
No, we are
do
going to look at that shortly. I'm going to take you through rental tax. So that question I will answer it when we get to rental tax.
Okay.
Allow me first proceed. We are going to attend to the questions afterwards, because I know every one of you has specific questions and we might not be able to actually carry on. But I will answer all your questions when we are done. Okay, so we go to the wear and tear schedule. When you're going to draw the wear and tear schedule, you have how many columns? 1, 2, 3, 4, and 5. So column number 1 is on the description. So column number 1 is on the description. Yes. Oh, sorry. So column number 1, I need to expand this. I don't know whether I can expand it beyond that. So column number 1 is description. Column number 2 is where you're putting class 1. Class 1 in brackets 40%. Get used to putting in these percentages. I have seen the student get in and they have not been used to putting in the percentages, and then they're asking, do I actually now apply 20%? Do I apply 35%? Especially if you've been looking at past papers, and the past papers where there were 4 classes, now you're dealing with 3 classes, and you're not sure about the percentage. So don't take it for granted. As you say class 1, make sure it is class 1 in bracket 40%. Please mute your microphone. Please mute your microphone. So class 1, 40%, class 2, 30%, class 3, 20%, and then the total. So you must know, how does the wear and tear schedule run? How does the wear and tear schedule run? Number 1, what are the headings that you actually need to be aware of? Item number 1 in the wear and tear schedule is called the tax written down values balance brought down. Call them opening balances. Ladies and gentlemen, in that exam, they are going to give you opening balances. These are the opening balances that I'm talking about. You see this note number 5, where they say the following information relates to asset additions and disposals during the year. A, opening tax written down values. So any student who is not able to pick these opening balances, really you'll have betrayed yourself, because they have given them to you. All you need is pick them and press them in the right place. Now, these notes, when you see these notes, they are categorized into 3. Number 1 is opening balance. Number 2 are additions. Number 3 are disposals. So in the notes, they're going to give you the opening balances. They will give you assets that were added, and they will also give you the disposals or assets that were disposed. All you need is to press them in the right place. So when it comes to the wear and tear computation, so you start with the opening balances. For each class, place them in the right place. Class 1, class 2, class 3, and then you have the total. The next heading is the additions. You've seen a note on additions. They will tell you these are the assets that were added during there. Your strength as a student is knowing where to place the assets, because all these assets they have given you are either going class 1, class 2, class 3, nowhere else. So you must know which assets am I going to put in class 1, which assets am I going to put in class 2, which assets am I going to put in class 3. Now, the advantage is, with the adjustment, the amendment that was made, the assets in the wear and tear are very easy to identify. Because class 1 only accommodates computers. And when I say computers, I mean real computers. I mean laptops and desktops. Do not think about your phones. Do not think about the ATMs. Do not think about whatever your cameras as computers. They are not computers. Here we are talking about real computers, either laptops or desktops. And then the data handling equipment. Here, when we are talking about data handling equipment, not anything handles data. We are talking about servers. We are talking about servers, meaning any other things, call them your projectors, call them your printers, call them anything else, does not go to class 1, because they have told you class 1 is computers and data handling equipment. That is what you're going to go in class 1. In class 2, again, there is a limitation of the assets that can go to class 2. They have told you that if someone is not in manufacturing, if someone is not in mining, if someone is not in farming, please don't put any asset under class 2, because class 2 only has plant and machinery used in farming, manufacturing, and mining. Plant and machinery used in mining, farming, and manufacturing. Ladies and gentlemen, any other asset which is not building, which is not land, which is not an intangible asset, goes to class 3. any other asset which is not a building, which is not an intangible asset, which is not land, you will take it to class 3. And examples of such assets are there. All kinds of vehicles, all kinds of construction equipment, specialized trucks, tractors, trailers and trailer mounted containers, rail cars, locomotives, aircraft, specialized public utility brands, office furniture, fixtures and equipment, and any other depreciable asset not included in any class. Now, in this, I want you to remember what we call the farm works. If you remember farm works, we have things that are used on the farm, such as labor quarters, such as fences, such as dips, such as water and electricity supplies. All those are categorized as farm works, and they go to class 3. They go to class 3. So remember, those are class 3 categories. When it comes farming, remember these 3 categories of assets and know how to treat them. When it comes farming, remember these 3 categories of assets and remember to treat them. We have what we call farm works. And farm works, I said, are examples of labor quarters, fences, dips, water and electricity works. Those farm works go to the wear and tear schedule under class 3. Category number 2 of the assets under farming is what we call.
We are in the hall. Jose?
We have lost you, please. Cancer, your network is not clear.
So I was saying when you go to the wear and tear schedule, I think power has chucked. We need to connect the generator first. Guys online, just give it a few minutes. I think power has chucked. Let's connect the generator.
Kata markup sheet.
Hi, you guys. And I just get chocolate.
Okay, so confirm if you can hear me now. Let's mute our microphones.
Yes, we can hear you.
Can you see my screen?
Yes, we can hear.
Yes, cancel.
Okay, so I'm going to repeat what I had just said in the way I entire schedule. So I'm going to repeat what I had just said in the wear and tear schedule. Remember, the wear and tear schedule, what are we looking out for? We are basically looking, I'm going to teach you about 4 principles in the wear and tear schedule that you must remember. 4 principles in the wear and tear schedule that you must remember. Number 1 is going to be about how you get the depreciation allowance, because that is one figure that you're going to take to the tax computation. Number 2 is the principle of balancing charge and balancing allowance, because they can also be able to test them in the wear and tear schedule. And number 3 is the principle. I have already talked about the principle of minor capital equipment. So those 3. No, actually there is also another 4th principle of the road vehicle. So 4 things in the wear and tear schedule that you must remember: how to get the depreciation allowance, wear and tear allowance. Number 2, how to calculate balance charge and balancing allowance. And number 3, how to implement the roads vehicle within the wear and tear schedule. And then the issue of minor capital equipment. Now, we said when you have a wear and tear schedule, the moment you see that note of assets in classes, then you know the examiner wants you to draw something that looks like this, known as the wear and tear schedule. And we said you're going to have how many columns? Column 1, column 2, column 3, column 4, and 5. Please mute your microphone. Column number 1 is for the description. Column number 2 is class 1 assets. Column number 3, class 2 assets. Class 3 assets, and then the total. We said everyone should get this one free of charge, because you're picking it from the question and bringing just the balance. All you have to do there is get the total. The next thing is the heading called additions. And additions, again, in the paper you actually see additions, as these are the assets that were added during there. All you need to do is place the values in the right space, and we are actually saying this is where you actually place them. Class 1, never put anything in class 1 other than computers and data handling equipment. And I said computers are computers. Do not baptize certain equipment as computers. For example, phones, ATMs, machines, your cameras, those, your printers, whatever you call it, you would want to call a computer. In this case, it is not a computer. Yes. Pardon? How do you call a memory? If a memory card is part of the computer, just like I'm going to talk about computer software. Computer software is part of the computer. It is part of the computer, and therefore it also gets in part in class 1. A computer software is different from any other software, because softwares are generally intangible assets, and they qualify for the allowance for intangible assets, and they will also have useful life. But when they tell you this is a computer software, a computer software becomes part of the computer, and therefore it will be part of class 1. But what I'm emphasizing that in class 1, you have computers and computer handling equipment. And computer handling equipment specifically mean servers and not any other item. Meaning, any other item that you'd want to baptize a computer. Things like these projectors, things like printers, things like cameras, things like phones, all of them go to class 3. Please never be tempted to put them in class 1. So class 1 is very restricted. Computers, we say they are either desktops or laptops. Those are the computers. And data and equipment is restricted to servers. Any other item go to class 3. When it comes to class 2, we also say that class is also restricted. It is only looking at plant and machinery used in mining, farming, or manufacturing. Meaning, if you're not dealing with a number, if you're not dealing with a person who is in mining, who is in manufacturing, who is in manufacturing or farming, then you're not going to put any asset in class 2. I'll give you an example. If you look at, for example, a question like this, if you see a question like this, the one that we are referring to, already the examiner has told you that you're likely to meet assets in class 2. Even when I am looking at additions, I am looking at plant and machinery that is going to be used in manufacturing, mining, or farming. For example, what is this person doing? This person is in the business of manufacturing because it is Uganda Sugar Limited and they are manufacturing. It's a manufacturing company, and therefore the expectation is you're likely to have assets in class 2. And even they have given you in the notes that even when you see the opening balances, you see assets in class 2, meaning I am indicating to you that there are assets in addition that are likely to be in class 2. Now you see another example where they have put 0 in class 2. Already at the back of your mind, think, if they have given me opening balances in class 1, they are 0. Why should I actually be tempted to put assets in class 2? Because the examiner is giving me some heads up. So always use your intuition and say, if there are no opening balances, why should I actually be tempted to actually put classes in class, rather assets in class 2, being a restricted class? In simple terms, I'm saying class 2 is extremely restricted, just like class 1. Now, all other assets go to class 3. And there are unique assets that you look out for, especially when it comes to farming. You see assets being called farm works. And farm works, we said, they include certain assets, certain costs, like labor quarters. When they say labor quarters, you would ideally see it as a building. But the law has said they are actually referred to as farm works, and they will always go to class 3 of the wear and tear schedule. So things like farm works, including labor quarters, including fences, dips, water and electricity supplies, all those are categorized as farm works. And I said farm works are different from farmhouses. A farmhouse is an industrial building that qualifies for IBD. So farmhouses and farm works are not the same. Labor quarters and farm works are not the same. Please remember that. Now, when it comes to classes, we said you put additions and you'll be reading saying, in this year, these are the assets that were added. After that, after you have added all the assets, the next line is disposals. You also put the assets that were disposed of. When an asset is disposed of, it is disposed of from its class. If they disposed of an asset in class 1, please put the disposal in class 1. If they disposed it in class 2, put it in class 2. If they disposed it in class 3, remove it from class 3. Now, the opening balance plus additions minus disposals give you this figure called net assets. The opening balance plus additions minus disposals give you net assets. Ladies and gentlemen, do not apply any percentages unless you have the net assets, because the percentage is applied on the net assets. Once I have my net assets, how do I get my net assets? Opening balance plus additions minus disposals give me the net assets. It is on the net assets that then I start calculating the depreciation allowance. So the net assets in class 1, I apply 40%. The net assets in class 2, I apply 30%. The net assets in class 3, I apply 20%. And that will be giving me my depreciation allowance, this that I have highlighted. You get the depreciation allowance after you have applied the different rates on the net assets. You get the net assets by getting the opening balances plus additions minus disposals. Once you get the total depreciation allowance, this one in yellow, please don't leave it in your working, because I've seen students, they are good at calculating the wear and tear allowance, but they leave it there and they forget to take it to the tax computation. So after calculating it here, you take it where? To the tax computation, where we saw capital allowances. And one of them was wear and tear allowance. And then you can go ahead and get your closing balance. How do you get the closing balance? The net assets minus the depreciation will give you the closing balances. That is step number 1, looking for the depreciation allowance. All that we have gone through, the most important item that we are looking for is the one that I have highlighted in yellow, the wear and tear allowance, which is one of the allowables under the tax computation. The next thing that I emphasized are 2 items called the balancing allowance and the balancing charge. Please remember these concepts. They are easy to remember. How? When I was getting these net assets, I was saying that I have my opening balance, I add the additions, I subtract the disposals. Sometimes it is possible that in the whole class of assets, you have disposed of all the assets. Whenever they tell you that all assets in that class have been disposed of, then that's when you start thinking about the balancing allowance and the balancing charge. So what do they mean? When I am actually, assume I am putting, let me show you. Let me use some figures, I will come back to them. So if I actually come here and say, my opening balance was 100,000. My additions, assume all additions for the computers were 200,000. What should I expect to have as my net? Assume I have, how much would be now in my class 1 before I make any disposals? This was 1 million and then 200. How much would that be? Let me actually make it, let me make this 10 million. Some people will be saying, but that is the minor capital equipment. So let me also make this 20 million. Okay. So we are talking about a 30 million in class 1. I come to dispose of now. I can choose to dispose of all the computers and data handling equipment at once, which were equivalent of 30 million. I am now disposing them of either at 35 million or, say for example, 27 million. When I dispose them at 35 million, what do I get? I get a gain of how much? Because at the end of the day, I am not going to have, I am going to say, I am disposing them at 35 million. When I do this, my net is going to be what? Let's see what the net is a negative 5 million. That should never happen. Your net assets should never fall below 0. Your net assets should never fall below 0. In other words, you should never have a net assets, yet you know you have disposed of all that assets. So the question is, how do I account for that 5 million so that it does not result into any item in? So what I do, I actually first put in my net assets, I put 0. So for me to achieve the 0, how much should I put in my disposal? Only 30. So if I have put the 30, how do I account for that imbalance of 5? Remember, it is over and above the value of the assets. Meaning, in simple terms, I made a gain. The assets were worth 30 million. I sold them at 35 million. That is that you would like it call a gain. In technical terms, we call it balancing charge. We call it a balancing charge. So in the way and tear schedule, we don't press it there, but we go and press it in the tax computation and add it in the tax computation because we want to tax it. It is a gain. So that's that you're calling a gain is what we are picking from here and taking it to the tax computation. Do you subtract it? Do you add it when you want to tax something? When you want to increase your chargeable income, do you add items in the tax computation? You subtract them. Every time you want to increase your chargeable income, you add items there. So this again, I want to tax it. So what do? I am going to add the balance charge into my tax computation. That's why when you look at the tax computation, a balancing charge is one of those items that we are adding. Remember when we are going through the add backs, one of the items that I told you to wait for is this item, a balancing charge. That is the income that is the gain I am picking from the wear and tear schedule because I disposed of all my assets and disposed them at again. So the condition is all the assets must have been disposed of. Please don't dispose of one asset and then you're looking for that computation. You won't get it. You only look for that computation if all the assets have been disposed of. And then the disposal proceeds are more than the value of the assets in that pool. I hope the balancing charge has entered. The opposite is a balancing allowance. It is possible that I have assets worth 30 million, but I have disposed them at 27 million, meaning I am getting a loss of how much? A loss of 3. That loss of 3 is what you call a balancing allowance. For it, you're going to come and allow it in the tax computation. If you looked at this line, the balancing allowance. So the balancing charge and balancing allowance all come from the PO, rather from the wear and tear schedule. If you want to use the simple language, a balancing charge is a gain, whereas a balancing allowance is a loss. But we don't use those terms of loss and gain. We use balancing charge and balancing allowance. Treatment in the tax computation, balancing charge, add it. Balancing allowance, subtract it, and you'll be good to go. That is the second category of items I wanted to explain. The other item that I want to explain that you must be aware of is what we call a road vehicle. A road vehicle. And I want you to open your ears properly. And I'm going to illustrate it here. Let me illustrate it on one of the items here. So, assume examples of road vehicles. These are passenger sitting vehicles that carry less than 13 passengers and they are not commercial in nature. In other words, if you move out all these vehicles that we see parked here, the ones that you came driving are what we call the passenger, rather are what we call the road vehicle. Now we know that these vehicles usually are used by individuals in companies, and therefore they are not used solely for business. And that's why when it comes to giving them capital allowances, when it comes to giving them wear and tear allowance, we limit the amount that can qualify for wear and tear allowance. And that limitation is at 60 million. Meaning if you bought a Land Cruiser, if you bought a Pajero, if you bought a Benz, if you bought whatever cars that you drive, the Harriers, the Subarus, and you have bought it as a company, when it comes to the wear and tear schedule, please mute your microphone. When it comes to the wear and tear schedule, you will only put there 60 million because that vehicle is taken to be a road vehicle. And we are saying that, I'll give an example. Assume I have a Benz. As a company, we have bought a Benz as an example. We have bought a Benz at how much? How much is a Benz? Those of you who drive Benzes. How much is the Benz? 150 million. Sorry, why is my computer jumping? So I have a Benz and I have bought it at 150 million. If I can expand this. So can we all see this? So 150 million. Section 27 says that because this is a road vehicle, please divide it into two. That when you purchased it, it now assumes that it is two vehicles. And those two vehicles, one is called the depreciable asset, and another one is called a business asset. So it says the depreciable asset is going to be worth 60 million, meaning take the 60 million to the wear and tear schedule and take nothing on the business asset. This will be 90 million. So every time you see, call them expensive vehicles, call them the passenger vehicles. In the wear and tear schedule under class 3, you're only going to take how much? 60 million, and the 90 million will not go anywhere. This business asset can only be touched as and when this Benz is finally disposed of. Other than that, if you leave the exam without disposing of that Benz, that 90 million goes nowhere. But if they tell you if this vehicle was purchased at a certain point and now it is being disposed of, they are trying to say, can you now deal with this business asset? Because the disposal of a business asset results into capital gains or capital losses. That is the only time you deal with that asset. So how do you deal with it? When you had purchased this Benz, assume you purchased this Benz in on 1st of January 2023. Let's say 2024. And you come and dispose it off on 31st December 2025. As an example. So you held it for the whole of 2024 and also the whole of 2025. If it comes to depreciation, you will depreciate this depreciable asset within the wear and tear schedule. But you have not been depreciating this vehicle because it did not go to the wear and tear schedule. You have now disposed it off on 31st December 2025, and you have disposed of this car, say for example, 100 million. 100 million. By the way, what are you disposing of? You're disposing of the Benz. Whereas theoretically you had divided it into two, but still you're disposing of one Benz. But remember, it is in two places. Part of it is in the wear and tear schedule, part of it is outside the wear and tear schedule. So this that we are calling consideration or proceeds, these are disposal proceeds. Disposal proceeds. Sometimes called consideration. It says that when you dispose of this asset, or separate this consideration between the two assets. Make sure that the depreciable asset has its part, and also the business asset also has its part. So how would I actually depreciate? How would I divide this consideration? So if I'm dividing the consideration, this is now for consideration. I'm going to say the consideration is how much? Is 100 million. So how do I divide this 100 million? I am actually going for this one. It will be this over the total. The total was how much? 150. Then times what? Times the consideration. So times the consideration. It means the The depreciable asset has a 40, automatically this one will have a 60. So we have divided the consideration. Where do you put the disposal proceeds of the depreciable asset? Where do we put the disposal proceeds of the depreciable asset? In the where and tear. So the one of the depreciable asset goes to the where and tear. But now we want to look at this asset called the business asset, because it will result into what we call capital gains or capital losses. So for the business asset, we are saying this one, take it to the wear and tear schedule. Wear and tear schedule. But this one, use it to calculate capital gains or losses. Capital gain or loss. Capital gain or loss. So the question is, how do I calculate capital gain or loss? We know that capital gain or loss, capital gain or loss equals to consideration minus cost base. Consideration minus cost base. Now the consideration is known because the consideration was, and me separate them so that it is easier to do the math. I want to put equal signs here, equals, and then I want to put consideration minus cost base. Cost base. Okay. So our consideration is known as how much? How much is our consideration? For the business, we are now concentrating on the business asset because the depreciable asset is dealt with. Now we are on the business asset. How much is the consideration for the business asset? 60 million. So this is known. The dilemma is on the cost base. Now, the cost base would have been 90 million, but we must make sure we don't take the original cost, but we take the net book value of that asset because we are assuming it has also lost some value. So the law says also that business asset that had not been taken to the wear and tear schedule, assume that it had been taken to the wear and tear schedule, how much depreciation would it have suffered? If this asset had been taken to the wear and tear schedule on 1st of January 2024, and it is disposed of on 31st December 2024, how much depreciation would it have suffered? And remember, when we are depreciating these assets, we use reducing balance basis, but we don't depreciate in the year of disposal. And the reason why we don't depreciate in the year of disposal, you saw how the calculation is done in the way and tear. We say opening balance, additions, we first remove the disposal before we apply depreciation. Meaning in the year of disposal, we don't apply depreciation. So if you're going to apply depreciation on this business asset, how many years are you depreciating it?
1 year.
How many years are you depreciating it? Knowing that you don't depreciate in the year of disposal. You're only depreciating it for one. And had you taken it the way and tear schedule, what percentage would you have depreciated with it?
20%.
20%, because it would have been in class 3. So what is 20% of the original cost? What is 20% of the original cost? It is how much? 18. Please confirm. So I would be saying that my cost base is the original 90 minus the depreciation that it has suffered. How much would that be? The original cost minus the depreciation it should have suffered, which would be 20% of the 90, which is 18 million. So 18 million is my depreciation. So in other words, when I'm looking for is this 18 million? Yes. When I'm looking for cost base, I get the original allocated cost minus what we call notional depreciation. And notional depreciation is what is the depreciation that asset would have suffered if I had taken it to the wear and tear schedule. And we said we depreciate it, and we don't depreciate in the year of disposal. So the cost base would have been how much? 72. But remember, the consideration is 60. This would result into a capital loss of how much? 12 million. This minus this. Now, I want you to pay attention here. This capital loss, if I am doing the same number one, I am going to take this capital loss as an allowable deduction within the tax computation. This capital loss, it reduces my chargeable income. Had I got a capital gain, I would add it on my chargeable income. That's how we deal with capital gains and capital loss in that number one. I repeat, if you have a road vehicle and the result is either capital loss or capital gain, the examiner is saying take it to the tax computation. If it is a loss, subtract it on chargeable income. If it is a gain, add it on chargeable income. That is how we tax it. Because capital gains are qualify as business income under Section 18, and capital losses qualify as allowable deductions under Section 22. That is one other technical area in the wear and tear schedule. I am not saying it is going to come, but it is likely to come, either at paper 17 or paper 11. I hope. Pardon? Yes. If it was a period prior to 1st July 2023, again, no. Maybe if you're saying period, because you see this wear and tear schedule. Just a second. The classes of wear and tear schedule changed in July 2021. Unless you're saying it is an asset that was purchased prior to July 2021. If it is after that, you have no problem. It will still be at 20%. But if it is prior to July 2021, that kind of vehicle was being depreciated at 35%. Are we together? That is what was the rate when the classes were 4. Because when the classes were 4, we had 40%, 35%, 30%, and 20%. But after July 2021, we have no problem with the different rates, because after July 2021, the rate remains 20%. Okay, that is the wear and tear schedule. Do we have any questions on the wear and tear schedule?
Also,
I have put a note. Yes?
Yes, please.
Please ask.
The first question. Okay.
I have an inquiry.
Yes.
When it comes to the entire consideration we had of 100 million for the vehicle,
yes.
What consideration do we use to split it into 40 million and the 60 million?
We use their original cost allocation.
Oh, okay.
We got, for example, the depreciable asset 60 out of the total cost, which was 150, and then multiplied by 100. We also got 90 out of 150 times 100.
Okay, thank you.
Yes, good
Any
afternoon,
other
Council.
question?
Okay, I
Yes,
had one question. Also,
Yes,
I had some
now my question goes on. There is a paper that I did, and
yes.
there was a Benz that was bought for the director. So
Yes.
this Benz wasn't included back when they were computing. They didn't bring this amount into the computations when they were getting the chargeable income. And here you've said when they buy a vehicle or a small you've called them, I think, towed cars,
They are
that
called
you
road
always take
vehicles.
only. Yes, you only take 60 million. So
yes.
Could you give me a reason why they didn't bring the 60 million the other time in the wear and tear for the director's car?
I can't explain how the solution was, because there are solutions that have an error. So I can't be explaining what the error is. but I'm actually telling you what the principle under section 27. If you can, please go to section 27 and you see what I'm doing. And we're saying that if you actually buy any road vehicle, it must be, you must divide it into two assets, one being a depreciable asset and another one being a business asset. The depreciable asset goes to the wear and tear to the maximum amount of 60 million. And then the depreciable asset remains outside the wear and tear until it is disposed of. When it is disposed of, make sure you also divide the consideration between the depreciable asset and the business asset. The one for the depreciable asset goes to the wear and tear schedule, whereas the one for the business asset is used to calculate the capital gain or capital loss. Remember, when you're calculating capital gain or capital loss, the formula is consideration minus cost base. Don't forget to adjust the cost base with the notional depreciation before you can get to the capital gain or capital loss. When you get the capital loss, please take it to the tax computation and remove it. When you get the capital gain, please add it in the tax computation. Okay. So there are certain.
Yes. Okay, Mr. Counsel.
Yes.
Counsel, I was asking something.
Yes.
You mentioned I wanted about classroom. I need
your
a
network has betrayed
clarity
you.
on the
Please put it in the
ATM
comments. Your
cards.
network is not clear. Put it in the comment. Your network is not clear. Someone says, "Sir, kindly pardon me on how to get the balancing allowance from the where." We are going back so many steps back. But I've said if you dispose of the whole class of assets in the wear and tear schedule, and if you add the opening balance plus the additions, but the disposal proceeds are less than the total of opening balance and additions, it means you're actually disposing of the value, you're disposing of the value of the assets in that class at a loss. That loss is what we call the balancing allowance. Aggie says, "Sir, pardon me on how to get the cost consideration of 72, my network went off." We said for you to divide the consideration, you get the original cost allocation. For example, the example we have divided the 150 between the depreciable asset and the business asset. And the depreciable asset had 60 out of 150. And the business asset had 90 out of 150. So when you get consideration, you also use those ratios. For example, the depreciable asset will be 60 out of 150 times the 100. And then the business asset will be 90 out of 150 times 100. Someone says, where will I put ATM and for a cost base? ATM is in class 3. ATM machine is in class 3. Okay, so guys, we are going to answer some of those questions later. Let's first finish this. I have pulled out some of the... Yes.
What's the impact if they said a commercial or non-commercial vehicle? What's the tax impact?
When they say this is a commercial vehicle, it means it is not a road vehicle. As long as they have said it is commercial, then it is not a road vehicle. Because we are saying road vehicles are vehicles that are not commercial and carry less than 13 passengers. So if it carries less than 13 passengers, but they are saying it's commercial, then it cannot pass as a road vehicle. You get it? Okay.
Yes. So in this case, what would you do for a
Guys,
commercial
our
vehicle?
time is very limited. The more questions you ask, the more we will actually eat into the time. But I can entertain at least 2 questions. Please go ahead.
To answer my question, so in the upper calculation where we started from, we proposed that such our disposal proceeds the 100, which is consideration. But here down in our calculation, when we are getting the gain or loss, we consider the 60 million as a consideration. Why? When yet we estimated the 100.
It means you missed one of the steps. You must have missed one of the steps. Remember, you're disposing of one asset called the Benz. Its cost was 150 million. You came and disposed it of at 100 million. But remember, you had divided this asset into two. You had divided it into a depreciable asset and a business asset. The 150, the depreciable asset has a ceiling of 60 million. The balance becomes the business asset. That in terms of dividing the cost. When it comes to the consideration, the disposal proceeds, you must also separate the disposal proceeds between the depreciable asset and also the business asset. And we said you use these ratios. For the depreciable asset, it will be 60 out of 150 times the total consideration of 100. When it comes to business asset, it will be 90 out of 150 times 100. And that's how we go to the 40 and the 60. We say the disposal proceeds of the depreciable asset go to the wear and tear schedule, whereas the one of the business asset is to calculate capital gains or capital loss. Now, can you see where the 60 came from?
Yeah.
Sir, I have a question. I understand.
Please go ahead.
I understand initial allowance was repealed. So even when they bring a number and it has those back dates before it was repealed, don't we bring it in our table, in our wear and tear?
First of all, vehicles don't qualify for initial allowance. So that should not be a problem here.
No, I mean for the general wear and tear schedule.
Unless the question they have asked you is for the period prior to 2023, which is not going to be the case.
All right, thanks.
I was asking about the capital gain.
Yes.
This one gives you the market value and the disposal proceeds. Of those two figures, which one should we use as a consideration?
They can only give you the market value and then the disposal proceeds if you've disposed of an asset to a related party or an associate. If you dispose of an asset to a related party or an associate, you will ignore the disposal proceeds but take the fair market value, because here you're now having a non-arm's length transaction. You only have to adopt the market value if the transaction is not at arm's length. Arm's length means it's the transaction between related parties.
All right, thank you.
Okay, let's come back. Our time is fast spent. So I have put a list of the assets that you could probably meet in the exam and where you should actually be pressing them. You'll have an opportunity in the recording to be able to see these kinds of assets. For example, if I talk about trucks, class 3, if I talk about buses, class 3, printing machine, class 3, generators, class 3, elevators, class 3, promotional trucks, class 3, distribution vans, class 3, computer printing press, class 1, professional cameras, class 3, office furniture and fittings, class 3, computers and printers. Now, of course, when they combine computers and printers, it's like a combined set. Then there you will actually place them in class 1. But ideally, a good examiner should not be mixing computers and printers at the same time. But I have seen some of the questions where they say computers and printers combined together. Laundry soap machine, that is manufacturing now, class 2. Soap mixer, that is manufacturing, class 2. Conveyor machines, of course, for manufacturing, class 2. Forklift, class 3. Delivery trucks, class 3. Mercedes-Benz, we say that is a roads vehicle, so limited to 60 million. Studio furniture, class 3. Billboards, class 3. Self-loader crane, class 3. Display racks, class 3. Compressor, class 3. Industrial mixture, plant and machinery used in farming, that is class 2. Mattress making machine, class 2. Toyota Jeep, that is a road vehicle. Toyota Kurga, that is a road vehicle. Forklift, class 3. Computer servers, class 1. CCTV cameras, class 3. Mobile phones, class 3. Desktop computers and laptops, class 1. Bedroom table, class 3. Pickup trucks, class 3. Lorry, class 3. Trailer mounted container, class 3. 10-ton trucks, class 3. Trailers, class 3. 3-ton trucks, class 3. Fixtures and fittings, class 3. Galvanizing machine, class 2. Saloon cars, class 3, etc, etc, etc. You see, maybe the expansion of labor quarters, that is class 3. Expansion of water drainage channels, that is class 3. etc, water supply works, class 3, those are farm works. So etc, you'll be able to see some of these as you go through
Excuse me,
the
sir.
recording. Yes, you excused.
Just below there is where there is tractors, and here they put them under class 2, but in the first table they were under class 3. So where should we
Which
consider
table
them?
now?
The one that you've just showed us, they are put in class 2, but the first part, the one that we're looking at up there, they were put under class 3. So there's a bit of confusion there.
So where is it in class 3 now?
The first part that
Rather
you
in
were
class
showing.
2. No, when they said tractors, because tractors can be either used in manufacturing, in farming, or in mining. If they have clarified and said these tractors are in the manufacturing, that's why I'm putting that note. If they say just tractors, where do we use tractors? In the construction. So if it is construction equipment, it remains in class 3. But if they have specified and say they are used now in manufacturing, farming, and mining, you're going to put them in class 2. What I'm emphasizing is that the examiner will tell you that this asset is used in manufacturing, farming, or mining. When he does so, please make sure you place it in class 2. When he's just saying tractors, we know tractors are actually, tractors are used, by the tractors are used in farming, not so. Tractors are used in farming. Idea they should actually be in farming. But don't we have tractors in construction? We also have tractors in construction. So if they are used in construction, please don't bring them in class 2. So here you actually bring them either, if for example I say, if you use it in construction. Does that help with the confusion?
Yes, thank you.
Okay, good. Quickly, let's run to the IBD. IBD is easy to calculate, and
Before
I
you
don't
go
want
to
to go.
IBD, there's a note you had given there about horticulture and what. That's what I wanted clarity.
I had already mentioned this note. This note is saying, please listen to this note. It says, whereas farm works are included in the wear and tear schedule, farmhouses, horticultural plants, and greenhouses are not. In other words, if it is a farmhouse, if it is a horticultural plant, if it is a greenhouse, don't take it to the wear and tear schedule. How do we do it? When you have farmhouses, give them to IBD. If you have horticultural plant and greenhouse, give them 20% capital allowance. That's what I mean, and I had already said this. Do you get it now?
Yes.
Okay, let's get to IBD. Guys, you can only calculate IBD when you have a building that has been put to use. The moment the examiner says, if you're reading an asset and they say it was put to use on this date, you know they want you to calculate IBD. And the simple formula for IBD is A times B times C over D. In simple terms, ladies and gentlemen, these are the elements that you look out for when you're looking for IBD. You have an exam that looks like, you have an element that looks like this. For example, they say in this note number 6, they say the qualifying amounts and the respective years in which URS factory houses were first put to use are as follows. Now, when you look at these buildings, in one statement, they will use what you call qualifying cost. In another statement, they will use what you call the capital expenditure, the cost of construction. What do they mean? When you're looking for IBD in the first place, look out for these 4 elements. Look out for these 4 elements. What are the 4 elements? A is known. A is 5%. Because we said IBD idea is depreciation. Depreciation of buildings. The only buildings that don't qualify for IBD are buildings where we sleep, used for residential purposes. So if we have a building but it is used for residential purposes, that
What
building is
about
not going to qualify for
hotels?
IBD. If you have a building that is used for residential purposes, it is not going to qualify for IBD. Because IBD, if I can go back, so you have different categories of industrial buildings. We have what we call industrial building, means any building which is wholly or partly used or held ready for use by a person in manufacturing operations, for example, a factory. Research and development into improved or new methods of manufacture, mining operations, an approved hotel business, an approved hospital, or an approved commercial building. And we are saying, I'm going to take you through these notes, the first notes that are very important for you to actually remember. But let's first see the formula for calculating IBD. Ladies, the formula is very simple. A times B times C over D. Now, A is 5%. Call it the depreciation rate. 5%. B B and C is where students get confused. And I want to explain. B, you need first ask yourself, is this an old building or a new building? If it is an old building, they are going to give you what we call a qualifying cost. That qualifying cost becomes your B. If it is a new building, they are going to give you the cost of construction. They're going to give you the cost of construction. That becomes your B for a new building. If it is an old building, the qualifying cost becomes your B. Now, C over D is only for apportionment. The way we apportion depreciation. If you have not used an asset for the whole year, we normally apportion the depreciation. Otherwise, the calculation would only be 5% times B. But we apply C over D because we want to apportion. And we can only apportion for a building that is new. Because a building that was constructed a long time, you have no business apportioning it because it has also been there 12 months, even in this year. The only time when you're going to find C over D being relevant is on a new building which has been put to use in that year when you're calculating. Because you're saying this building, it was put in use, but it has not been used for 12 in this year. So I must get the number of days it has been in. For example, if they say for the year ended 30th June 2024, meaning it started on 1st of July 2023, it simply means any building that was put to use after 1st July 2023, it means for this year it did not spend 12, and therefore you must look for the number of days this building has been used, because we apportion using number of days and not number of months. That's why D is standing at 365 days. And we are saying C could be less than 365 days. And you must count the number of days from the date this building was put to use. If it is a new building, and that is if it was not put to use on the very first day of the year. If it was put to use on the very first, for example, 1st of July 2023, yet the year is ending 30th of June 2024, you're saying it actually took all the 365 days. So C and D will be the same. But if your year started on 1st of July, but this building was put to use, say, for example, in September, it means you have those 3 first months where it was not in use, and therefore the days are no longer 365 days. You'll have to count how many days it was put to it was in use, and that becomes your C. And I am saying that apportionment is only relevant if you're dealing with a new building. It is irrelevant if they told you the building was there. Because if it was there, it means even in this year it was used for 365 days. So when you're dealing with an old building, simply put 5% on the qualifying cost. You'll have your IBD. If you're dealing with a new building and it was not put to use on the very first day of the commencement of the year, then look for C by counting how many days it was put in use, and then that will be your C. So you have your A as 5%, you have your B as the either qualifying cost or the cost of construction if it is new, and then C, number of days it has been put to use, and then D as 365 days, and you get your IBD. What are the things that you must remember? Number one, if, let me actually do the notes here. Some of the things that you should always remember. First warning is on approved commercial building. We are saying that an approved commercial building does not include a building let out or used for residential accommodation. What if I gave you a building like Indians do it? I have the lower side where I have a supermarket, but I sleep in the upper side. It means this whole building is used for both business and also residential purposes. So what do? I first calculate the IBD of the whole building, and then I remove the portion for residential purposes. And the part of the business is what I claim, because we have said the part that is used for residential purposes cannot be claimed. Number two, a new industrial building or extension of an existing industrial building means a building on which construction was commenced on that. The note that I want to actually make is that when you make an extension of a building, or you incur capital expenditure on a building, that building becomes a separate building. You have a building like this, you have added another floor. That other floor becomes a separate building, and therefore you must treat it as if it's a new building on its own. Or you have incurred a capital expenditure on an existing building, that part becomes a new building, and therefore treat it as a new building and give it its own IBD. Then I talked about this. I also talked about farmhouses. I said farmhouses also qualify for industrial building. Do we have any questions related to industrial building that I have not talked about? It is the easiest thing that you can find. For example, I want you to see this.
Also, what of the boys' quarters?
Pardon?
The boys' quarters.
The boys' quarters or the staff quarters?
Any of those.
Those qualify as labor quarters. I told you we have to differentiate between labor quarters and farm houses. Now I want you to see something like this. They say the factory building in Jinja, first put to use on 1st January 2017, had a qualifying amount of 232. Is this an old building or a new building? This is an old building. We said when it is an old building, what are you looking for? You're only looking for a qualifying amount and multiply by 5% and move on, because you don't have any issues of apportionment. Building number two, factory units in machine first put to use on 1st July 2023 had a construction cost of 425. This is a new building, but it was put to use when? On the very first day of the year, and therefore you also don't need to apportion. Do you realize that the one that is new is they are giving you the cost of construction, whereas the one that is old they are giving you the qualifying amount? So don't get confused. For the old building they're going to give you the qualifying amount, and for the new building they're going to give you the cost of construction. Now, if this building, for example, this new one, had not been put to use on 1st of July 2023, assume it had been put to use on 1st of September, it means your C, you must calculate your C, because it has not been used for 365 days. Yes. 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 It doesn't matter. At that point, it doesn't matter. It was put to use a long time. Remember, you're now dealing with the year 2023, 2024. So the historical perspective is not for you to take care of. You're now taking care of the period starting from July 2023 to June 2024. And that building qualifies for 5% per year. The only question you're asking in this year, has it been used for 365 days? Do I have a base upon which I calculate IBD? And we're saying the qualifying cost is what you base on to calculate IBD. And the qualifying cost, by the way, they're telling you that this cost has already benefited from any other deductions that were supposed to be qualifying, the initial allowance and all that. That's why they are calling it now a qualifying cost. So that in this year, you're not bothered about what could have actually happened on that building. Apply 5% and move on. Where they give you a new building is where you have a problem. Where they give a new building, you look for B and C. B is the cost of construction. But C, they're asking, has it been used for 365 days? If the answer is no, then you must count the number of days. If this building is not put to use on the very first day of the year, it means there are some days where the year passed without this building being in use. Can we remove them from the 365 days for us to get our C? Because we are now apportioning the 5%. It can't qualify for the whole 5%. You must apportion that depreciation allowance. Okay? Any other question on IBD? Okay, so that marks the end of your number one in as far as a company is concerned. I'm now going to highlight a few things. Yes.
Council.
Yes.
I have a question. I understand. Sorry, I joined in late, but I wanted to help me.
I hope you're not taking us back because our time is fast spent. But go ahead and ask.
I wanted for you to help me differentiate on that, only on rental income and rental expenses. If both of the things are given, which one do we use to calculate rental tax? Rental expense or rental income?
I will talk about that when we are discussing the rental tax. I'll get to that. Don't worry. But for the tax computation, the income tax computation, we said for the rental income, you come and knock it out, remove it in the tax computation. If they have given you the expenses related to that rental income, please also add them back. So the adjustment is add back the expenses related to rental income and subtract the rental income. And then you can get out and do a working on rental tax. Okay, I'm now going to make mention about the things that you must remember if this number was on an individual.
Council.
All the principles that we have discussed are applicable also on an individual. All the allowables, all the non-allowables, all the capital deductions are also applicable to an individual. So you will all be almost doing the same thing. But there are certain changes that you must remember when you're dealing with an individual. Number one is on the things that you're going to be adding back. Whereas all these things are relevant, when you're dealing with an individual, always remember that there are costs that an individual is going to incur on his behalf. If I am the owner of the business, most of the times I'm tempted to actually pick money from the business. I am paying for my fuel because I am going back home. I am paying for some school fees for my children. I am even paying for my private expenses as an individual. I am paying salaries to myself on top of paying my workers. So anything that is paid to the owner of the business, that individual, any cost that goes to that individual is a non-allowable deduction. Why? Because when you're a sole proprietor, we don't expect you to pick money and incur expenses on your own, on yourself. Why? Because you as a sole proprietor, you must wait for your profit because all that profit belongs to you. It is only when we have determined your profit that we can allow you to pick money from. It means anything that you have been spending on yourself is called a drawing. So look out for all the items. If they tell you this cost, this expense relates to the individual, the owner of the business, you know that is an unallowable deduction. So add it back. That is one adjustment. All others are relevant. But on top of these all non-allowable deductions, all expenses that go to the individual are non-allowable deductions. Whether he's fueling his car and whether they have told you that the car he drives it to work, it doesn't matter. But is it his private vehicle? That one is now going to be a non-allowable deduction. The second adjustment that you need to know is when it comes to application of the tax rate. I had already explained this. For an individual, they do not apply 30%. Rather, they apply the individual income tax rates that you have in your question paper. Those rates that they give you at the end of the question paper are the ones that you apply when you're dealing with the number of an individual. The next item I had emphasized is on this line of income that has suffered withholding tax as a final tax. We said when it is an individual, the items expand. They go just beyond the interest on treasury bills and government securities, which is for the company. Individuals have other items. They have the 4 items: interest on government securities and treasury bills. They have interest from financial institutions. They have commission on mobile money distribution, rather airtime distribution and mobile money agents. And then they also have dividends. All those are relevant to an individual, whereas they don't apply to the company. Those are the few adjustments that you need to consider when you're dealing with a number of an individual. We are now done with the company. We are done with an individual. The next thing that I want...
When you were pregnant, that day when we were cooking 6 things at the same time.
Can you stop being pregnant and concentrate? You're going to get pregnant after
that's
the
question. One question.
You can postpone the pregnancy. Yes.
I missed out on the initial allowance.
I did not talk about initial allowance, and I don't want to talk about it. Initial allowance is not relevant for you now. Initial allowance was scrapped off the law since July 2023. You're not going to be examined on anything to do with initial allowance.
Okay, thank you.
Okay. So, if you want to stand up and stretch, but we are now going to discuss partnership.
Excuse me, sir.
Yes, you excuse it.
Yes, I'm inquiring
Now, all
how
the
the
principles that we have
treatment.
discussed are relevant to the partnership, but there are specific issues you need to master under partnership. That's why I want you to stretch and make sure that you're fresh to listening to the partnership, because it could be number 1 and you'll be shocked. The other, in the last sitting in paper 11, it was number 1. Those who said, I am not going to understand partnership got shocked. So don't get the shock again. Please ask your question. We are now we only have now 5 minutes of a break. And the reason why I've given you a break is to get fresh mind. Yes.
I'm asking the treatment for these 3 things under employment, the interest on government securities, the interest on the financial institution for dividends. Do you all give them?
I am coming to employment income. When it comes to employment income, you'll ask that question.
Okay, please.
Excuse me, Council.
I don't have time for lunch, so don't go for lunch. Yes, please ask.
I was inquiring that times that they set and they on IBD and they give us the costs of building instead of a qualifying cost. For example,
and it's an old building.
Yeah, it's not very old, like 1 year back.
That's what I'm saying. If the building, when I say new, it means in that very area that you're dealing with. That is the new building that I'm talking about. If they are going to give you a building that was put to use a year back or so many years back, then you actually they are going to give you the qualifying cost.
There is a question I saw. They only gave us costs, and then we had to first apply the 5%, we get the balance, then that became our qualifying cost.
You don't apply the 5% unless they were testing you on initial allowance where you had to first remove 20%, not 5%.
Okay.
Okay, so stretch, you're also stretching for the next 5 minutes. We are coming back here at 50 minutes. Before we go for lunch, we must go through this partnership number. After the partnership number, we go for lunch.
Cancel.
We are now in a break of 5 minutes. First break off.
And last question before we break off.
Yes.
Would I be right
Yes,
to
go ahead.
consider? Would I be right to consider IT equipment under class 1?
Why are you considering it? I told you class 1 is only computers, and computers mean desktop and laptops. So IT equipment, how does the IT equipment come to class 1?
Because they are data handling equipments.
I told you don't interpret your data handling equipment the way you know it. Data handling equipment are servers, not IT equipment. Because IT equipment can mean anything.
Thank you.
Sir, you said these things that are different, these things that make individual different from business, the 4 things: treasury bills, bonds, commission on airtime, and dividends. We take them for allowables. We less them.
Yes, we take them to allowables if you're dealing with the number of an individual. The interest on treasury bills or government securities, the interest on fixed deposit accounts, the commission on airtime distribution and mobile money, and then the dividends. If you find them in the POL and you're dealing with an individual, take them to the tax computation under allowables.
Okay. Yes, maybe Council, before you change, now those things that you've taken that just asked, do you give a tax credit for them when you after getting one individual?
No. All those things that you're taking to the tax computation, please don't give them any credit. We are saying they have already suffered withholding tax as a final tax.
Thank you. That applies for the individual, but for the company, you do the tax credit. Is that correct?
If it is for the company, if they are for the company, the only thing that goes the tax computation for the company is interest on treasury bills and government securities. Any other thing, you don't take it to the tax computation, but you give them the withholding tax credit. If it is fixed deposit account, if it is dividends, if it is a commission on airtime distribution and it is done by the company, you don't take them to the tax computation, but you compute the credit. Withholding tax credit is what you put to the tax computation. Guys, I also need a break of 5 minutes. Please, let's come back at 55 minutes past midday, because we must go through the partnership before we come back. Before I go, someone is asking about returnable containers. Returnable containers don't go to the wear and tear schedule. Returnable containers, they are going to give you what you call the diminution value. Diminution rate, when they give you the diminution rate, what you would call the depreciation rate for those returnable containers, apply the diminution rate on the value of the returnable containers, and that diminution is what you take to the tax computation as an allowable. If you see returnable containers being taken to the wear and tear schedule, know that that is an error and it is in contravention of Section 27. If you read Section 26, if you read Section 26 of the Income Tax Act, they tell you returnable containers don't go to the wear and tear schedule, but they will give you the diminution rate that you can use to depreciate them or to determine the allowance for returnable containers. And that diminution is what you take to the tax computation.
Excuse me, Council. How do you treat 50% of expenses related to rental income?
I said I'm going to respond that when I am addressing rental tax.
Okay, thank you.
Excuse me, Council.
We are in a
We're
break
in a
of 5
break.
minutes. Please.
Abang Kene.
We don't have a lot of time, so let's start. Guys online, are you there?
Yes.
Okay. So we are coming back in 1 minute. Power is back. They are going to reconnect the power and remove the generator. So in about 3 minutes, we'll be back in 2 minutes. Okay, so we are back, and in a few minutes we should be able to have the projection. Please confirm, guys online, confirm if you are able to see my screen.
Yeah, we can
And
see.
if you're back, am I audible enough?
Yes, sir.
Okay, good. So we are now going to look at the partnership. Definitely, partnership is one of the numbers that you can actually be sure is either going to come as number one, or it is like it also come as one of the numbers. So as you look at this, as you look at number one, like I told you, focus on either a company, an individual, or a partnership. Meaning that you don't get into that exam unless at least you have tried a number on a company, tried a number on a partnership, and tried a number on an individual, because any of them can actually show you as your number one. Now we have discussed the principles for a company, and we have made the adjustments for an individual. We are now on a partnership. Now, partnership will also apply all the principles that we have laid down, but I'm going to add the other few principles that you must be aware of that are different from the individual, are different from the company. Number one is that you must know the steps that you must take when you're doing a number on partnership. Step number one is that you're going to calculate the chargeable income of a partnership as step number one. Step number two is you must calculate the distributable profits or loss. That is step number two. Step number three, you must calculate the chargeable income of every pattern. And finally, step number four is you must calculate the tax payable for each pattern. I'm going to repeat this. Step number one, you must calculate the chargeable income of the partnership. Step number two, calculate the distributable profits or loss of the partnership. Step number three, calculate the chargeable income of each partner. And step number four, calculate the tax payable for each pattern. I am repeating it for emphasis purposes. If you don't go through these four steps, you are not doing a partnership number. So step number one, calculate the chargeable income of a partnership. Step number two, calculate the distributable profits or losses of the partnership. Those two steps are done in the computation of the partnership. The next two steps are done in the computation of each partner. So the first two steps are for the partnership. The second two steps are done in each partner's accounts. So the first two steps is chargeable income of the partnership. Step number two, get the distributable profits or loss. That is done in the partnership computation. Once you're done with the second step, get out of the partnership computation and now start looking at each of the individuals. As you look at each of the individuals, you're looking for the chargeable income of each individual partner plus their tax payable. The reason is partnerships don't pay income tax. It is the partners that pay the income tax. But the partnership calculation helps us to determine the chargeable income and the distributable profits. This is how it is going to run. If in terms of structure, you're going to first draw a computation the way we did it, up to the point of chargeable income. So the way we have been running it, you run up to the point of chargeable income. The moment you get to the point of chargeable income, how did we get there? We actually go to the profit or loss before tax. We added back the non-allowable deductions. We allowed or we subtracted the allowables, and we got chargeable income. Now, when it comes to the partnership, on top of the non-allowable deductions that you picked, I want you now to master these ones because these ones are specific to partnerships. I repeat, on top of the non-allowable deductions that we understood already, you're now going to look for the specific non-allowable deductions when you're dealing with a number of partnership. What are the things that you actually pick out? Number one, you're going to look for any interest on capital. Any interest on capital. In other words, any items that are paid to the partners, anything that comes from the partnership to the partners. In other words, when they tell you the partnership paid this to the partners, then you know that that is a non-allowable deduction. Why? Partners are not meant to be paid by the partnership. They are also meant to wait for the profit. Remember, a partnership is a business venture where two or more persons come together to do business in common for purposes of sharing the profit. It means anything that you pay to the partners along the way is not a business expense for partnership, and therefore must first be added back. So what are the things that you're going to meet in your exam? Number one, interest on capital. Every time you see interest on capital, please add it back because they are paying it to the partners. Number two, partners' salary. If there is a partner that is paid the salary, please make sure you add it back. Number three, partners' private expenses. They tell you the partnership paid for their holidays, they paid for school fees of their children, they paid for their transport, they paid for anything. Anything that is paid for the partners is a drawing. The partners have picked the money before they determine the profit, meaning that expense is not the partnership expense, but it is a drawing that was made prior to determining the profit. Now you're trying to ask what would have been the chargeable income if these partners did not pick anything from the partnership. That's why I'm emphasizing. And for simplicity, I told you at this point, you might understand or cram. So this is what you're going to do to earn marks. Anything that is paid to the partners earns you 3 marks. Anything that is paid to the partners earns you 3 marks. So where do you earn the 3 marks? Anything that you add back, you will subtract it in the same computation, but take it to the partner's account. How? I'll give you an example. Assume a partner is paid a salary. I am adding it back because it's a non-allowable deduction in the hands of a partnership. But after getting chargeable income, I want you to see here. After getting chargeable income here, that very same salary that I had added back, I am now going to subtract it for purposes of determining distributable profits. Because after getting the chargeable income here, I am comfortable that this should have been the chargeable income of the partnership. But then I'm asking, is this income still with the partnership which was already shared with the partners? So I am doing in accounting, we say, I am debiting the partnership account and crediting the partners' accounts. How do I do it? How do I do it? So everything that I had added back, when it comes to the chargeable income, I again less it because now I want to determine the distributable profits. Now everything that I have list here, I come to each individual partners and put it there. Let me repeat this. I said you either cram it or understand it. Principle number one, we are saying that partners can never be paid anything from the partnership unless they have determined the profit. Meaning, everything that you're going to be seeing when you're reading your question on partnership, and they say this was paid to the partners, you know that that item is going to give you 3 marks. Step number 1, that item must be added back. Step number 2, when you determine the chargeable income and you want now to look for the distributable profit, that item must be subtracted. And as you subtract it from the partnership computation, but bring it to the partners' individual accounts. By illustration, I want you to see what I am seeing. We have 2 sets. We have this computation that comes and ends on chargeable income. That is step number 1. Step number 2 is to help me get the distributable profit. What do I do when I want to get the distributable profit? Whatever I had added back, which relates to the partner. Whatever I had added back, which relates to the partner. For example, here I've added back interest on capital is received by partners, partners' salaries, and any private expenses of the partners. Whatever I have added back, I come back and subtract it here for me to be able to get the distributable profit. Whatever I have subtracted here, when I finally draw each of the partners' accounts, whoever received salaries, I put it under their account. Whoever received interest on capital, I put it on their account. Whoever received any drawings, I also put it under their account. In simple terms, we said we take 4 steps. Step number 1 is determining chargeable income. How do we determine chargeable income? Getting the profit or loss
That's
before
why I
tax.
stopped using them
That's
last
what we go to previous. Please mute your microphone. Please mute your microphone. So the one that we were doing of picking the profit or loss before tax, that one you picked it. The next step was add back non-allowables. And we said all the non-allowables that we have discussed are also applicable here. But we are saying on top of what we have studied, can we pick now the expenses that we are incurred by the partnership, but on behalf of the partners? What are those things that are paid by the partnership to its partners? And the examples that are common that you're going to see is interest on capital. So when you hear that partners have been paid interest on capital, what do? Come and add it back. They are not meant to be paid interest on capital because they came to bring money together for purposes of making a profit. You can't go ahead and pay them interest on capital. That's why we are adding it back. 2, salaries. Partners are not meant to be paid salaries. They are making an appropriation before they determine the profit. So anyone who has been paid a salary, add it back. The next one are the general costs that have gone to the partners. They have said partners withdrew money from the partnership, either to pay the school fees of their children, either to go for a holiday, or you're paying for their transport. Whatever you're paying for the partner, we say that is a drawing because they are picking money from the partnership before it is mature. They are supposed to wait for the profit. So anything you pay to them, please add it back because your intention is to determine the chargeable income of the partnership before any partner picks any money from the partnership. That's why we are adding it back. So any item, look out for the items which have gone to the partners. All those items, add them back. After adding them back, definitely, you will also go to the less allowables. Under less allowables, all the items that we discussed as less allowables are relevant. But on top of that, when it comes to the other income, you remember the other incomes which we said suffer withholding tax as a final tax? Now you're going to treat them as though they were individuals because ideally partnerships are actually individuals running the business. So the way we talked about interest on treasury bills, the way we talked about interest on treasury bills and government securities, the way we talked about fixed deposit account, the way we talked about commission on airtime distribution and mobile money, the way we talked about dividends. If it is a partnership, you're also going to bring them here because we are saying in the hands of the partnership, they are treated as though they were individuals. So also bring them there. Then you will be getting a figure called chargeable income. You remember how we got the chargeable income? Not so. After chargeable income, what did we remove from the other computation? Don't make a mistake. Don't remove any carry forward losses. Why? Because partnerships don't have carry forward. Because every year any loss that happens is shared between the partners, so they cannot have any carry forward. That's why when you get chargeable income here, don't be tempted. Even if the examiner told you the carry forward, the losses from the previous period was this, is only tempting to see whether you understand that principle. Partnerships don't have carry forward loss. Why? Because every year, whether you have made a profit or loss, you share it among the partners. So we don't have anything you're carrying forward. So stop at chargeable income. You'll have picked your first step. It means the first step, all you need to know that you had not known from the previous discussion are the things that we are adding back, and then the income that is subjected to withholding tax as the final tax. Your marks are in these items that have gone to the partners' pockets. Interest on capital, salaries to the partners, any drawings, any money that they have actually picked from the partnership, all those are supposed to be added back when you're computing the chargeable income. Now, when you get the chargeable income, the next step you go through is for determining the distributable profit or loss. And the exercise there is very easy. Because whatever you had added back that relates to the partners, whatever you had added back that relates to the partners is what you're subtracting now. I am not saying everything you added back, but I'm saying the ones that relate to the partners is what you are subtracting. If I had added back interest on capital, I must come back here and subtract it. If I had added back partners' salaries, I must come back here and subtract it. If I had added back drawings or private expenses of the partners, I must come back and subtract it. Yes. Now, interest on drawings, who is suffering the interest on drawings? It is the partners. It doesn't come here in the computation, but it will go to the partners' accounts, and I will show you where we're going to actually pick it. Which one? Interest on drawings. Yes, it's an income to the partnership that is taxable. So that one you don't touch it. But when it comes to the partnership, rather partners' accounts, I will show you where to pick it. But I wanted you first of all know the first two steps of getting chargeable income and also getting the distributable profits. Because the biggest marks, if the examiner is testing you, is only going to be testing you because he knows you know all the other non-allowables, you know all the other allowables. So he's now looking at the specifics of the partnership. And I'm saying everything that goes into the pockets of the partners is what you're adding back, over and above the other non-allowable deductions that you know. Then all the things that you have added back here come back in the adjustment because you are adjusting chargeable income for purposes of getting distributable profit or loss. So everything that you had added back, you are now subtracting. If you know that you added back interest on capital, come and subtract it. If you know that you added back partner salaries, come and subtract it. If you know that you added back any drawings, come and subtract it. The only item that goes to the partner where you don't need an adjustment in the tax computation is interest on loan. Partners can also give loans to the partnership, but that is over and above their capital contribution. Now, when a partner gives a loan to a partnership, it is seen as a legitimate transaction. The partnership suffers interest expense, but the partners get the interest income. And we're going to see that interest income within their computation, not in the computation of the partnership. So the only transaction that you can't add back is the loan, interest on loan. That one, don't add it back because it is seen as a separate transaction. The reason why we add interest on capital is because they are violating the principle of partnership. You contributed the capital for purposes of making a profit. You cannot come back and say, I'm going to charge you interest on capital. Yet the only benefit out of your capital contribution was to share the profit. That's why we are adding back the interest on capital. A loan arrangement is a separate arrangement, and that's why it is not a transaction that affects the tax computation. Now, after getting
about
this
bank
distributable
loan?
profit, pardon?
About bank loan?
The bank loan has no problem here. The bank loan is the same way we actually discussed it the other side. Here, I am only pointing out the additional issues that you need to focus on when you're dealing with a partnership. And those are the issues. Now, when you get to the distributable profit or loss, how did you get it? By getting the chargeable income and removing those other items. You have now a distributable profit. You get out of the partnership now. You're done with the partnership. The next persons you're going to be dealing with are partners. Because we said you can't do tax computation within the partnership. Partnerships don't pay tax. All they do is that they distribute the profit or loss to the partners, and then you go to the partners, each of the partners, and deal with them. Do we have any question on step 1 and step 2? Because we say step number 1 is determine chargeable income. Step number 2, determine the distributable profit. Are we okay with step number 1 and step number 2? Good. So we go now to step number 3. When I get out of that computation, I now look at each of the partners separately. So assume now I have 3 partners. I have partner A, I have partner B, I have partner C. I am trying to make sure that each partner gets what we call their chargeable income. So how do I do it? Remember, these partners have income they have earned from the partnership, but they also have other sources of. And now I'm looking at them as separate individuals and trying to get their chargeable income. So you first prioritize incomes they pick from the partnership. The first set of income they are getting from the partnership is the share of profit or loss. So this profit or loss, this distributable profit or loss, if it is a positive, it is a profit. If it is a negative, it is a loss. But at this time, you want to distribute it among the partners in their profit sharing using profit sharing ratios. So what are you doing? I am coming to this distributable profit, and if A's percentage is, say, for example, 40%, I apply 40% of this figure, and that becomes for A. If B is 60%, I apply 60% of that, and that becomes the profit share or loss share of that, and also C. Now, ladies and gentlemen, the principle under partnerships is that in the absence of profit sharing ratios, you use their capital contribution. So if you get into an exam and they have not given you the profit sharing ratios, but they gave you the capital contribution, then you use the capital contribution as their profit sharing ratios. If you have 3 partners and one has contributed 100, another one has contributed 200, another one has contributed 300, it means if you want to actually know the ratio of the first one, it will be 100 out of the total, 600. The second one will be 200 out of 600. The third one will be 300 out of 600. There you're using the capital contribution in the absence of profit sharing ratios. If they have given you the profit sharing ratios, again, you must know how to apply the profit sharing ratios. If, for example, they have told you it is 1 to 2 to 3. If I'm looking at the one of 1, it will be 1 out of 6. If I'm looking at the 2, it is 2 out of 6. Then times the distributable profit or the distributable loss. So that is line number 1. After that, Then come back to these items that you subtracted. We say these items must be brought now to the individual partners. That's why you earn 3 marks when you have any payment to the individual partners, because you first add it back, subtract it when you're making adjustment for distributed profit, and then bring it to the individual partners account. So don't miss those 3 marks, because it's like repeating the same thing but pressing them in the different places. Now, whatever we had subtracted there is what we are bringing. Everyone who receives the salary, place it under them. Everyone who received interest on capital, place it under them. Now, someone who had asked about the loan, remember they had given a loan to the partnership. We hadn't adjusted anything because we left the interest expense with the partnership. Now, they earned interest income. Bring it to the person who had given interest, rather loan to the partnership. That interest income must come to his account because he has earned some money. Then drawings. Everyone who picked money from the partnership must also be brought there. Now, someone was asking about interest on drawings, because interest on drawing means there is a rule that whoever picks money from the partnership is going to be charged some interest. Who is earning the income? The partnership. But who is incurring the expense? The partners. So this time, that's why we are bringing it as a deduction, because any interest on a drawing is a deduction in the partner's account. Now, I have also indicated that you must bring any other income.
Excuse me, sir.
Just a minute. You must bring any other income that each of the partners has earned elsewhere other than in the partnership. Because these guys could actually have multiple sources of income. As long as that income is not income that has suffered withholding tax as a final tax. And remember the 4. If it is income that has suffered withholding tax as final tax, please don't bring it here, because you don't want to tax it altogether. So income such as interest on treasury bills and government securities, interest on fixed deposit accounts, dividends, commission on airtime distribution, don't bring it here, because for it has already suffered withholding tax as a final tax. But if they tell you this partner also earned some business income outside Uganda, bring it here, because it is meant to be taxed. If they tell you that this partner also earned a salary somewhere in another entity, also bring it here, because that is part of his income. In other words, all other sources of income that these partners have earned, bring it under their account. But it should not be income where withholding tax is a final tax. Now you have what we call chargeable, because when I aggregate all that income into the partner's account, I get chargeable income. It is at this point that you ask, did anyone last year carry forward any loss? Because the partners can carry forward a loss, whereas the partnership can't. The partners can carry a loss because for them they are taxable persons. So if they gave you any carry forward loss for any of the partners, this is the time to bring it there. And then you have your adjusted chargeable income. Now, when you have adjusted chargeable income, ladies and gentlemen, calculate tax payable, go to the individual income tax rates, because now you're applying the individual income tax rates. Make use of those rates that they put for you at the back of your exam. So the individual tax rates, apply them on the chargeable income, and you'll be getting your tax payable. After that, what are the relevant credits that could be available to the partners? Number 1, withholding tax. But remember, this withholding tax throughout the year could have been suffered by the partnership. The withholding tax was suffered by the partnership, but you must divide it among the partners using their profit sharing ratios. So if they told you that there is withholding tax with the partnership, divide that withholding tax among the partners using the profit sharing ratios. This other income also could come. They could tell you the partner earned some income outside Uganda and he was taxed. That becomes his foreign tax credit. They could also tell you that this salary that were paid to the partners also had suffered some pay as you earn. That is also part of their credit. So any income that you bring in here, if it has suffered tax already, and that tax is not the final tax, you bring it as a credit. And examples of those are foreign tax credits, withholding tax credits, pay as you earn, provisional tax paid. Some partners will have paid some provisional tax, and then you'll have their net tax payable. So in this, again, I can repeat this. In the partner's account, what do you bring there? Their share of profit or loss. And where is it coming from? From the distributable profit. If it is a loss, bring it as a negative. If it is a profit, bring it as a positive, using their profit sharing ratios. The items that you had subtracted when you're getting distributable profits, all of them bring them into each partner's account. And any other item of income they have earned, which has not yet suffered withholding tax as a final tax, also bring it. The other important thing is partners can have carry forward loss. Please bring it if it is there. And then you have your adjusted chargeable income. From the adjusted chargeable income, apply the tax rates. The tax rates are individual tax rates. And then afterwards, remove all the available credits. And I said the available credits could be foreign tax credits, where they tell you a partner earned some income outside Uganda, so you have brought the income into his computation. Why don't you also give him the tax that he paid outside Uganda? Withholding tax credit, I said withholding tax credit, most of the time it will be suffered by the partnership. You have to distribute it among the partners using the profit sharing ratios.
Excuse me, sir.
Just a minute. Number 3 is pay as you earn. If they have already paid some pay as you earn, remember you're bringing their salaries into the computation. It means if they have already been charged pay as you earn now becomes their credit. They could also have paid some provisional tax. Also remove it as their credit, and then you'll be having their net tax. And we are saying when not income tax is paid by the partners themselves and not the partnership. So when computing the partners' chargeable income, include all other incomes earned by the partners outside or inside Uganda. Okay. Do you have any question? Please ask any question that you have on the partnership, and I will answer it before we go for lunch.
I am inquiring on the interest on drawings. It doesn't apply for the step 1 and step 2.
Interest on drawings does not apply in step 1 and step 2. Why? Because interest on drawings is an expense of the partnership, rather of the partner. It is the partnership now charging the partners for drawing money from the partnership. So it is income to the partnership, which is taxable in the partnership account, accounts, but it is an expense in the partner's accounts. And it only comes when you're drawing each partner's account as an expense. That's why we are putting it in brackets.
All right, thanks.
Any other question? Guys,
excuse me, Council.
Partnership can come as number 1. It actually came. And if the performance of that number was not satisfactory, they will bring it again as the number 1. So it is, especially those who are doing paper 11, because it was number 1 as in paper 11. So if people did not do it well, and look at the examiner's comments. If the examiner's comments say that people did not do it well, expect it. You can be shocked to be brought as number 1 again.
Excuse me, Council.
Just a minute, there is a question here in the physical class. Let me first pick it and then come back to this. Yes. Yes. You now pick that net because they have not given you, if it's a good exam, they'll give you the salary plus the pay as you earn that was paid. If they don't give you the pay as you earn that was paid, please don't bother giving him the pay as you earn credit. But if they have given you the pay as you earn that was paid, they actually indicate to you that pick the salary, but also pick the credit. Yes, otherwise you'll be charging him twice. Online come through.
Excuse me,
Also,
Khan.
Yes.
there is a scenario where you find that a farm operates in its own premises, valued by the certain amount. On the top of that, there is one of its members contributed some money towards that. Towards its own premises. Let's say the operates in a certain premises which valued at 60 million, and one of the partners contributed 40 million. Is that one
Now
qualifying for?
all they are telling you is that the contribution of the partner. Remember, when partners come together, they must contribute to the capital of the partnership. So if they tell you the contribution of the partner was in form of that contribution, that is his capital contribution. And remember, the assets of the partnership belong to the partnership. They don't belong to the partners. That's why every time, even if you're a partner and contributed in form of an asset, that asset has ceased to be yours, but has become the partnership's asset for purposes of capital deductions. And partnership will also be given capital deductions the way we actually gave the capital deductions to the other businesses. Any other question? I want to release you for lunch.
Yes, I heard you talk about the interest. For example, if we are dealing with interest on treasury bills or fixed deposits, do we include them in the first calculations by allowing them as allowable deductions?
Now, if a partnership has earned these four incomes that we talk about as suffering withholding tax as the final tax, and these incomes are interest on treasury bills and government securities, interest on fixed deposit accounts or from financial institutions, commission to airtime distributors and mobile money agents, and dividends. We are saying those incomes have suffered withholding tax as a final tax, and they will be subtracted in the tax computation of a partnership, just like we do for individuals. Because the character of a partnership is that the individuals are the ones behind the partnership. Legally, a partnership is not a separate legal entity. That's why we treat the incomes earned in that category as incomes earned by the individual. So when we are drawing the partnerships chargeable income under less allowables, we are bringing all those incomes under this column called, or under this row called, the incomes that have suffered withholding tax as a final tax.
Yes, Council.
And we are not going to put them under the individual accounts.
Yes, Council.
Yes.
My question is, in the event the partner has a salary which is different from the salary of the partnership, will he be able to ask for a tax credit in his partnership?
If they have told you that this partner is also earning a salary outside the partnership, I said that is part of his income that you bring into his account. For example, there could be salaries from the partnership, but there could also be other salaries that they have earned outside the partnership. You also bring the salaries, and if they have given you information about the pay as you earn that was paid by that partner, you're going to use that pay as you earn as a credit, because pay as you earn is tax that you have paid at source. They have already charged tax on that salary.
Even that pay as you earn from the other salary, which is not from the partnership, can give him can accept the tax credit.
Yes, the moment you bring his other salary, you must also bring his pay as you earn that he has already paid.
Okay, thank you.
Any other question? By the way, the partnership is one of the easiest numbers. As long as you master those 4 steps, you realize that there are transactions that are only repeating, and you're getting the marks. Okay, so guys, that marks, yes.
Okay, it is simple. It is simple question. Okay, there is a scenario where you
Why
find
are you
that
saying it's a simple question yet you're asking it? Yes.
okay, I got some confusion. Okay,
Uh-huh.
there is
Then
where
this
we
is a hard
find that
question.
okay, let me ask my question. Then we see whether it is simple for you or it is hard for you, or for the rest.
But it is
Okay,
hard. Okay,
the
go ahead and ask.
question. Okay, there is where you find one of the members of the partners do some consultation work, maybe abroad.
Yes.
They say he earns some money.
Yes.
Then in top of that, he charged a withholding tax on
Yes.
his gross amount.
Yes.
Are we consider it?
That's what I just said. That's what I said. That if they earned, for example, any consultancy fees outside Uganda, for example, even if it is inside Uganda, but they have earned that income, please bring it here in the computation of their chargeable income. For example, the example you're giving me is that they have one of the partners has earned consultancy fees outside Uganda and they charged him some withholding tax. So bring the gross income here of the consultancy fees, first tax it, after taxing it, the tax that was charged from him becomes his credit, known as a foreign tax credit.
Okay, we use it in a two way, in a chargeable income and unchargeable income for the partners.
You only use it on chargeable income of the partners because that income is only relevant to the partner. Please do not take to the partnership incomes that belong to the individual partners. Individual partners' income is their own income. So only treat it under each individual's account. Don't take it to the partnership account.
Okay, thank you.
Okay.
That's how
Guys,
simple
I want to
was.
release you for a break. Yes?
Excuse me, Council.
I hope this is the last question so that I can release you for a break. Otherwise, I'm going to hold you. The moment it gets to 2:30 without you coming back, I will have to start. So you're eating into your time. I am going to give you a break for only 1 hour to 2:30. So the more questions you ask now, the more you're eating into your time. Yes.
Pardon me on how we are supposed to get the share that the profits of the partners in case we are not given the profit sharing ratios.
I said if you're not given the profit sharing ratios, you apply the capital contribution ratios. If each one has contributed, say for example, you have 3 partners and each one has contributed 200 million, it means you're saying they are going to share the profits equally. If one has contributed 100, another one has contributed 200, another one has contributed 300, you get the 100 for the first one over the total times the profit sharing, the profit to be shared or the loss to be shared. You get it?
Okay, thank you.
Council.
Yes.
Shall we be able to get this Excel sheet and the recordings?
This recording is on YouTube and they are going to give you access to the YouTube.
What
But you
of the
can
Excel?
also, yes, all this is whatever we discussed is going to be available on YouTube.
Thank you, sir.
Okay. So guys, I am releasing you for a break and we are coming back here at 2:30. So go pick what you can pick. And when we come back, we'll do employment income, we'll do VAT, and we'll do customs. So again, your afternoon is pre-packed. But the good thing is that the ones that are remaining are really very short. All the others are very short. For me, the biggest part is what you have covered. And once you get this right, once you get this income tax right, I can guarantee you that you're going to pass. But if you miss this income tax, then the possibility of you passing the other numbers is hard. Because for paper 11, this income tax number takes 40 marks. For paper 17, it takes 50%. So you can see where you can see where your risks are. So anyone dying must first of all die with that number. One, make sure you're comfortable with an individual, you're comfortable with a company, and you're comfortable with a partnership. And you realize that the other numbers, VAT, employment income, and then and then customs, it will be easy for you to earn the extra marks. So release for now. We come back here at 2:30.
Thank you a lot for your time, sir.